In this presentation, we will take a look at the Child and Dependent Care Expenses Credit. This is different from the Child Tax Credit. If you have questions about the Child Tax Credit, we do have a presentation on it as well. This will be a fairly long presentation. If you would like to jump to relevant topics within it, you can go down to the description where you'll find the breakout of the description of relevant topics and a link that can take you directly to them. Most of this information can be found in publication 503, so if you have further questions, you can go there as a starting point for them. We will discuss some of the requirements to qualify for the Child and Dependent Care Expenses credits, and we'll give some examples along the way. So we'll see what the requirements are, what the amount of the credit is, and as we go through those, we'll jump through two tax software so we can see the actual calculations and the actual tax form and what this will actually look like in the tax forms. In this presentation, we will be discussing the Child and Dependent Care Expenses Credit. Note that this is different than the Child Tax Credit, so this is the credit related to expenses for child and dependent care. We will be discussing the question of, can I claim the credit? This information is coming from publication 503. To be able to claim the credit for child and dependent care expenses, you must file Form 1040 or Form 1040-NR, not Form 1040-NREZ, and meet all the tests you must meet to claim a credit for child and dependent care expenses. So obviously to claim the credit, we need to file the tax return. That typically is the Form 1040. Note there's not any 1040A or 1040EZ in 2018 because they've basically been done away with. So if you had a 1040A, 1040EZ in the past, you will typically be filing the Form 1040 here. It's a shorter 1040 form, and then any added information, as there will be with things like a credit, will be on separate schedules as we'll discuss in future. Back to the text. Tests you must meet to claim the credit for child and dependent care expenses. To be able to claim the credit for child and dependent care expenses, you must meet the following tests. 1. Qualified person test. The care must be for one or more qualified persons who are identified on Form 2441. We'll see more about that later. Test 2. Earned income test. You and your spouse, if filing jointly, must have earned income during the year. So, however, rule for student spouse or spouse not able to care for self under you must have earned income. We'll talk about these later. So we'll get into more detail about each of these qualifications. But in essence, you got to have some income typically. And remember that the IRS is usually looking for that to be oftentimes to be part of the requirements for things like credits of this nature, some type of earned income to kind of incentivize work to be able to get the credit. Number 3, work-related expense test. You must pay child and dependent care expenses so you and your spouse, if filing jointly, can work or look for work. So note that the theory or the gist of the law or the rationale of the law is that there's a credit so that there's care, so that someone can go and work. So that's going to be a specific kind of need that we're going to have to look into and see what the requirements will be related to work, because clearly the credit is given, or the idea of the credit, or one of the ideas of the credit, this is my interpretation of it, is the credit is designed to incentivize work. So the credit is there for those expenses that allow people to then go and be able to work, including child care expenses. So we'll have different situations, and you could think of scenarios. Well, what if the two people are married? Do both people have to be working? Or what if it's a single individual in work, and what qualifies as the type of expenses for work related? So we'll get into more of that in detail at a future presentation. Number 4, you must make payments for child and dependent care to someone you and your spouse can't claim as a dependent. And we can imagine the kind of question that would come up here. If we had 2 children and we paid one child to take care of the other child, then could we then have the expenses that we paid for the one child to be a deduction in this case? And typically the answer would be no if both the children would be dependents on the tax return. We'll talk more about this later, but for now, back to the text. If you make payments to your child, he or she can't be your dependent and must be aged 19 or older by the end of the year. You can't make payments to your spouse. So obviously we can't do the same for our spouse. So if a married couple can't pay expenses to the other spouse that could then be deductible for tax purposes for childcare if they're married filing joint. B, the parent of your qualifying person if your qualifying person is your child and under age 13. C, payments and relatives or dependents under are these work-related expenses later, so we will discuss this information in more detail later. Number 5, joint return test. Your filing status may be single, head of household, or qualifying widower with dependent child. If you are married, you must file joint return unless an exception applies to you. See what's your filing status later. So we'll go into more detail of this, but note what they're basically saying is the married filing separate is something they're going to be very skeptical of to take this credit. So you can see that we have married. If someone is married, then you have to file married filing joint in essence for the most part to be able to take the credit, because you can imagine a situation if someone is married and then they're going to say, well, the two are going to have married filing separate and try to see if they can get a larger credit in that case given the qualifications for the credit. So the IRS wants to avoid that. If you're married, you really only have two options: married filing joint typically, or married filing separate. If you file married filing separate, you have more difficulty to qualify for particular credits, including this one. Next item, provider identification test. You must identify the care provider on your tax return. See care provider identification test later. We'll discuss this more in the future. However, we typically need to provide information about the person that we paid for the caretaking of the child. So that next item, if you exclude or deduct dependent care benefits provided by a dependent care benefit plan, the total amount you exclude or deduct must be less than the dollar limit for qualifying expenses, generally $3,000 if one qualifying person was cared for, or $6,000 if two or more persons were cared for. If two or more qualifying persons were cared for, the amount you exclude or deduct will always be less than the dollar amount, because the total amount you can exclude or deduct is limited to $5,000. See reduced dollar amount limit under how to figure the credit later. So we'll get into some more details of the calculation of the credit in future presentations. But for now, just note that this rule has to do with benefits provided by a dependent care benefit plan. So we'll get into more detail about these tests in future presentations. For now, we just want to get a look and feel of what the tax return would look like with regard to this expenses credit. Here is our test 1040. We're not going to get into a lot of detail right now. We just want to get a feel for what this credit would look like on the tax return. We have our head of household filing individual here. We've got the one dependent. So we've got the one dependent. We're going to say that the income is $75,000, so $75,000, and then the adjusted gross income also $75,000. Standard deduction because of that dependent is head of household status $18,000, bringing the amount of taxable income to $57,000. Tax being calculated at $7,094. So there's the $7,094. Now this is the child tax credit. That's not what we're concentrating on here. We're concentrating on the expenses for the child care, so child and dependent care expenses. So typically, oftentimes, you'll have both of those, because you'll have the child tax credit up to $2,000, and then possibly the dependent care expenses credit if it is applicable. So the dependent care expenses credit then will be filed with Form 2441, so child and dependent care expenses. So we see some information here. We'll get into the more detail about this information, but you can go through some of the calculations, and then at the bottom of this, as we'll get into more detail later, we'll finally get the calculation of the $600. So in our case, we're saying that $10,000 was paid, and we're going to say that $600 is the amount of the credit. That credit, as you can see here, is going to go to Schedule 3, line 49. So if we go to Schedule 3 then, and we go to line 49, there's the credit. So note that now that under the 2018 rules, we'll have this Schedule 3. So the Schedule 3 then is going to be necessary so that we can record this credit. There's the credit, line 55, and then we can see that this is going to go to the Form 1040, line 12. So then if we go back to the 1040 and we go to line 12 then, here is line 12. So it's a little tricky the way that works, because here's the 2,000 and then it jumps up to 2,600. Why? Because this is including the amount on Schedule 3. So 2,000 for the child tax credit then, and then the 600 that we just saw on Schedule 3 brings it to 2,600. And then we know that, that's a dollar for dollar credit. So this was our liability minus the 2,600 brings the liability down to 4,494. And so that would be where we're at. We're not talking about any tax payment here. We're just talking about the liability at this time. We're calculating that liability. So we'll get into more depth about these schedules in future presentations. In this presentation, we will discuss who is a qualifying person with regard to the child and dependent care expenses credit. Remember that this is a different credit than the child tax credit. We're talking about the child and dependent care expenses credit versus or not the child tax credit. This will be in the publication 503, or the information will be from publication 503. Who is a qualifying person? Your child and dependent care expenses must be for care of one or more qualifying persons. So when we're thinking about the expenses that we had for the care of an individual that we would like to take as this credit, then they have to be a qualifying person. A qualifying person is, number one, your qualifying child who is your dependent and who was under age 13 when the care was provided, but see child of divorced and separated parents or parents living apart. We'll talk about that later, but that's the general rule. This, of course, is the most common type of qualification for this credit. Number two, your spouse who wasn't physically or mentally able to care for himself or herself and lived with you for more than half of the year. So the spouse could be there, so husband or wife could be there, but only if they're physically and mentally not able to care for themselves and live with you for more than half of the year. Number three, a person who wasn't physically or mentally able to care for himself or herself live with you for more than half the year and either A, was your dependent, or B, would have been your dependent except that 1, he or she received gross income of $4,150 or more. 2, he or she filed a joint return. Or 3, you or your spouse, if filing jointly, could be claimed as a dependent on someone else's 2018 return. So again, this would be kind of another kind of unusual case. You can see where the case is in the same general area, a person who wasn't physically or mentally able to care for himself or herself. Not the number 2, of course, was similar. However, that was the spouse, husband or wife. Here we're saying someone who is not the husband or wife still has the inability to care for themselves and lived with you for more than half of the year. The expenses related to them may still then be qualified under, at least as a qualifying person. Now, typically that would be then your dependent. Normally you would think, well, what if it wasn't the spouse, but what if it was, or a child, but what if it was some dependent, someone else that qualifies as a dependent, and they were physically and mentally unable to care for themselves? Well, that would typically be the case. And they even have some exceptions above and beyond. That's what B is saying. B is saying, even if they weren't a dependent, then under these kind of unusual circumstances, they would still be something that you might be able to write off the care expenses. So these are going to be items that are there that usually disqualify them from being your dependent, and would not then disqualify them from having the expenses on the tax return. So he or she has gross income, so the income test, which might be something that kicks them off from qualifying as a dependent. So they may not qualify as a dependent under that case, but still be able to take the expenses. Filed a joint return. Again, that's usually something that means you can't claim them as a dependent. And then, of course, this one, if your spouse could be claimed as a dependent on someone else's return, probably a condition where then they might not be able to be claimed as a dependent on yours, but you may still be able to have the qualifying person under these rules. Dependent defined. A dependent is a person other than you or your spouse for whom you could claim an exemption. And now note that this terminology is a little bit unusual now in 2018 because the exemptions have been basically removed. So we still have the dependent, we have the dependent care or the dependent credits related to the qualified child or other dependent. So just note that that's probably there because of old terminology. Before 2018, we had, of course, exemptions for the dependents, and now we have some other kind of benefits related to them. So in any case, moving on back to the text. To be your dependent, a person must be your qualifying child or your qualifying relative. However, The deductions for personal and dependency exemptions for tax years 2018 through 2025 are suspended, and therefore the amount of the deduction is zero. But in determining whether you may claim a person as a qualifying relative for 2018, the person's gross income must be less than $4,150, not zero. Qualifying child. To be your qualifying child, a child must live with you for more than half the year and meet other requirements. So this is going to be the qualifying child, probably the most common type of qualifying person for this credit. For more information about who is a dependent or qualifying child, you can go to publication 501. So if there's any added questions, any unusual circumstance or any unusual situation, want to check out publication 501. Physically or mentally not able to care for oneself. Persons who can't dress, and so this is of course a definition of what it means to be physically or mentally not able to care for oneself. So if we're looking at that type of situation, well, what does it mean in order to write off these expenses for someone to be physically and mentally not able to care for oneself? Here's what they're providing here. Persons who can't dress, clean, or feed themselves because of physical or mental problems are considered not able to care for themselves. Also, persons who must have constant attention to prevent them from injuring themselves or others are considered not able to care for themselves. Persons qualifying for part of year. So persons qualifying for part of year. You determine a person's qualifying status each day. For example, if the person for whom you pay child and dependent care expenses no longer qualifies on September 16th, count only those expenses through September 15th. Also see yearly limit under the dollar limit later. Birth or death or otherwise qualified person. So we're getting obviously the time limits here. So we're talking about the time limit, and we could see some exceptions here. So what if in a case where there was a birth or death, then of course we have that partial year type thing again. Well, isn't that an exception? Wouldn't there be an exception, you would think, to the time period that you'd have to live with someone? Back to the text. In determining whether a person is a qualifying person, a person who was born or died in 2018 is treated as having lived with you for more than half of 2018 if your home was their person's home more than half the time he or she was alive in 2018. So if someone, if they were born, even at the end of the year, December 31st, then they were obviously living in your home for that time period, 100% of the time period that they were here on the earth, and as a separate thing, a separate person. So then you're good. Next item, back to the text, individual taxpayer identification, ITIN, for aliens. So now we've got the identification number. Normally, of course, we would have the social security number. Now we're talking about some other type of number. The IRS needs some number. We're some number to the IRS. So the other number is the individual taxpayer identification number. If your qualifying person is a non-resident or resident alien who doesn't have and can't get a social security number, SSN, use that person's ITIN, ITIN. The ITIN is entered wherever an social security number is requested on the tax return. If the alien doesn't have an ITIN, he or she must apply for one. See Form W7, Application for IRS Individual Tax Identification Number. So you can go to irs.gov and you can look up the Form W7 and go for there, look at the instructions as well. An ITIN is for tax use only. It doesn't entitle the holder to Social Security benefits or change the holder's employment or immigration status under U.S. law. All ITINs not used on the federal tax return at least once for tax years 2015, 16, 17 will expire on December 31st, 2018. Additionally, all ITINs issued before 2013 with middle digits, the fourth and fifth position, I'll let you read those positions, will expire at the end of 2018. ITINs issued with middle digits, you can read those, are expired unless a renewal application was already submitted and it was approved. All expired ITINs must be renewed before being used on your tax return. You can see the irs.gov website for more information there. Adoption taxpayer identification number. So this is the A10. So having to do with an adoption situation. So if we are in a situation with an adopted child, this would apply. If your qualifying person is a child who was placed in your home for adoption and for whom you don't have a social security number, you must get an ATIN, so ATIN for the child. And once again, you could file the form W7A this time, which can be found on the irs.gov. So file form W7A, application for taxpayer identification number, pending U.S. adoptions. And again, go to the irs.gov and you can at least start to search that out. Type in W7A. Hopefully you can find the form and instructions related to that, or at least where to go from there. Child of divorced or separated parents, or parents living apart. Even if you can't claim your child as a dependent, he or she is treated as your qualifying person if, the first one, the child was under age 13 or wasn't physically or mentally able to care for himself or herself. So we have the age, or once again, the exception for the caring, not being able to physically or mentally able to care for themselves. The next item, the child received over half his or her support during the calendar year from one or both parents who are divorced or legally separated under a decree of divorce or separate maintenance, and separated under a written separation agreement, or lived apart at all times during the last 6 months of the calendar year. Next item, the child was in the custody of one or both parents for more than half the year, and you are the child's custodial parent. So again, this would be kind of an unusual situation where the child of a divorced or separated parents, or parents living apart. So even if you can't claim your child as a dependent, he or she is treated as your qualifying person if. So in other words, even if we don't have a dependent situation, they're not our dependent, they still might be a qualifying person and meet that test. And if they meet all other tests, we might still be able to get a credit related to these expenses. Back to the text. The custodial parent is the parent with whom the child lived for the greater number of nights in 2018. So the custodial parent, remember, it's kind of like the default parent. So if there's a question between the two parents, usually the custodial parent is the one that would claim the parent as the dependent and typically have any other kind of tax benefits related to it, unless there's some kind of special circumstance within the divorce. And if there's questions about who is the custodial parent and whatnot, typically the rule is that who the child lived with the longest. That's going to be kind of rule number one, typically the person that the child lived with more throughout the year, and they define that as the number of nights typically. Back to the text. If the child was with each parent for equal number of nights, the custodial parent is the parent with a higher adjusted gross income. So then if it's an even split, which kind of often happens, where in kind of a separation agreement, there might be an even split. In those cases, between the number of nights that the child lives there, it goes to the person with a higher adjusted gross income. My interpretation would be that the logic of that is that there would be more support, financially with that person or something like that. But in any case, that's what we have here. So for details and an exception for parent who work at night, see publication 501. So there might be an information you might say, what if the other parent has the kid all day and I have the kid all day and the other parent has the child all night because I work at night, right? That doesn't seem fair because they happen to be counting nights rather than days, maybe. So there might be an exception in publication 501 in that kind of circumstance. Back to the text. The non-custodial parent can't treat the child as a qualifying person even if that parent is entitled to claim the child as a dependent on the special rules for a child of divorced or separate parents. In this presentation, we will use tax software to test who is a qualified person related to the child and dependent care expenses credit. Here we have our test 1040. We have our one dependent, and it's going to be qualified for the child tax credit. We're here concentrated not on the child tax credit, but on the child and dependent care expenses credit. If we scroll down, we see the $2,000 for the child tax credit, and then the added $600. That $600 is going to be our child and dependent care. We see that on Schedule 3. So Schedule 3, here's our $600. Then if we go to form 2441, here's 2441, child and dependent care expenses. We have the information for the child and dependent care expenses being the 600, the end of the calculation. Then we're going to go back to the data input screen. So this is for this particular software, we enter this information into the data input screen. Now we just named it dependent 1, so that would be the first name. Dependent Smith is the dependent 1, and the last name. We have the date of birth, which is 1/1/2005 here. So we note that there's usually an age 13 limit. In other words, your qualifying child who is your dependent who was under age 13 when the care was provided. So typically you'd have to be under age 13. So if we had 2018, so if we say 2018 minus 13, that would be 2005. So let's say if we had 1/1/2005, if we keep this date, you'll note we'll go up and we'll say, all right, on the forms, it looks like everything is still being calculated. We're just using the tax software to see if it will not calculate the information based on just the date. So this isn't a complete proof of the software of the tax code, but oftentimes the software will be related to the tax code so we can test some things out and see what the top software does as an indication to the code, right? So if we go over here, we still have everything filled out. It looks good. If I go back and I change the date and we say, well, let's make it one day prior to that, 12/31/2004. So I'll put that in this input screen, and then we'll also put it in the dependence screen. And then go back to our forms, and you'll note that it basically kicks it out there. It basically says, all right, we're not going to accept that because of the age limitation. So now the age limitation has kicked it out. We still have the 2000 child tax credit being calculated. That's not what we're focused in on here, but we could see that the added 600 is gone and the added schedule has been gone due to the change of age. So now we're going to keep the age there, so they don't qualify on the age, but we're going to now say that they're disabled. So we're going to say they're a dependent that's disabled, and we're going to go to the dependents and say that they are a dependent, but the relationship we're going to say is other. So other as opposed to a son or daughter for the relationship in terms of the dependent. So we have a dependent other than a child. And we're not really testing the dependencies here. What we want to do is just say, okay, well, what will that do if we have basically a qualified dependent that is not able to care for themselves? Then what will happen to the expenses? Well, if we go back, we're going to say, all right, now it's reappeared on Schedule 3. So they don't meet the age requirement. We have a dependent here. And so we have the dependent 1, other, not qualifying for the child tax credit. Remember, that's different. So if we scroll down here, the child tax credit is here. We're looking for the child dependent care expenses credit, and that's still being taken. So if we go to the Schedule 3, there's the 600, and if we go back to our form 2441, here's our calculation for it. In this presentation, we will discuss the qualification of you must have earned income with relation to the child and dependent care expenses credit. This information coming from publication 503. To claim the credit, you and your spouse, if filing jointly, must have earned income during the year. So note, this is another type of credit that is designed to allow someone to work. So that's going to be the goal of the credit. So therefore, to qualify, typically you're going to need some type of earned income. Usually that would be like a W-2 type of income. Back to the text. Earned income. Earned income includes wages, salaries, tips, other tax employee compensation, and net earnings from self-employment. A net loss from self-employment reduces earned income. Earned income also includes strike benefits and any disability pay you report as wages. So note that once we have this kind of earned income requirement, then of course there becomes a lot of questions in terms of, well, what qualifies as earned income for the credit or not? Because when you're thinking about, well, how do I maximize the credit, or what, when would I want to include income or not if I had the choice to, or what am I required to or not? Typically, of course, it's going to be W-2 income. It's going to be fairly straightforward, but we can think of a lot of different scenarios where it might be something different. A very common scenario being self-employment income. So if you had self-employment income, then that'll typically count as well. That'll be something that you usually would be reported on a Schedule C. We'll take a look at some examples shortly. Generally, only taxable compensation is included. For example, foreign earned income and Medicaid waiver payments you exclude from income aren't included. So note there's going to be some types of income that you might not have included. Sometimes foreign income isn't included in income for taxes because you probably have to pay taxes if it's earned in another country. You have to pay taxes to them, and therefore it's not taxable to the U.S., or else you would be taxed 2 times. But if it doesn't count for taxes to the U.S., then usually it's not going to be included on the credit. So if something's for tax purposes, we don't want to include it usually in gross income if we don't have to, because then we have to pay taxes on it. But for this credit, of course, if it's not included in gross income, then it doesn't count for earned income with regard to the credit. Back to the text. However, you can elect to include non-taxable combat pay in your earned income. And this is really that one area that has some flexibility, because usually the code says, hey, either you have to include something or you do not have to include it. And this is basically saying combat pay, they're giving some options there. They're saying, hey, if there's combat pay and you want to include it for this purposes in order to maximize the credits, then you may be able to do that. So that's one area where you have some flexibility. So if you have combat pay, then it might be worth doing some research on it, because there could be some leeway on what you can do with it to maximize your tax credit here. Back to the text. If you are filing a joint return and both you and your spouse received non-taxable combat pay, you can each make your own election. In other words, if one of you makes the election, the other one can also make it, but doesn't have to. Including this income will give you a larger credit only if your or your spouse's other earned income is less than the amount entered in line 3 of Form 2441. In other words, the combat pay could help or hurt. It just really depends where we're at, depending on we have to have some earned income in order to get the credit at all. But then, of course, if the earned income gets to a certain levels, we may start to lose the credit. So we'll talk more about the income limitations later. And as we get to that point, then you can start thinking about, well, if I have combat pay and I can decide to increase or decrease my income, then should I include it or not will be dependent on whether or not it will be increasing or decreasing the credit. And again, the credit is gonna do something like this, right? It's gonna go up with earned income, and then it's gonna, at some point when earned income hits a certain amount, then of course it's gonna go back down, because the idea of there is that the people that are earning that much don't need it anymore, whereas down here the government is trying to incentivize work and give the credit specifically to allow work to be there, and that's why it's there in the first place. So we'll talk more about those earned income, or what's the credit amount in relation to income levels and the amount of expenses paid later. You should figure your credit both ways and make the election if it gives you a greater tax benefit. Tip: you can choose to include your non-taxable combat pay in earned income when figuring your credit for child and dependent care expenses, even if you choose not to include it in earned income for earned income credit. Again, very unusual here. So now we're saying that, you could have it included just for this portion and not for that portion. So combat pay, a lot of flexibility with these credits that could have a big impact on the taxes, but it's going to take some maneuvering to figure out how to best apply the combat pay. It's not the easiest thing in the world to decide whether or not to include it for one or the other or both. So you're going to have to do some scenarios. Or exclusion or deduction for dependent and care benefits. Back to the text. Members of certain religious faiths opposed to Social Security. This section is for persons who are members of certain religious faiths that are opposed to participation in Social Security Act programs and have an IRS-approved form that exempts certain income from Social Security Medicare taxes. These forms include Form 4161, Application for Exemption from Self-Employment Tax for use by ministers, members of religious orders, and Christian Science practitioners. So that's a special case right there. And then we're going to say Form 4029, Application for Exemption for Social Security and Medicare taxes and waiver of benefits for use by members of recognized religious groups. Each form is discussed here in terms of what is or isn't earned income for purposes of the Child and Dependent Care Credit. For information on the use of these forms, see publication 517. So if you have more questions on that, publication 517. You can find that irs.gov. Social Security and other information for members of clergy and religious workers. Now, obviously, Form 4361, whether or not you have an approved Form 4361, amounts received for performing minister's duties as an employee are earned income. This includes wages, salaries, tips, and other taxable employees' compensation. So that would be income for the purposes of our credit here. However, amounts you received for ministerial duties but not as an employee don't count as earned income. Examples include fees for performing marriages and honorary for delivering speeches. Any amount you receive for work that isn't related to your ministerial duties is earned income. Form 4029, whether or not you have an approved Form 4029, all wages, salaries, tips, and other taxable employee compensation are earned income. However, amounts you received as a self-employed individual don't count as earned income. What isn't earned income? Earned income isn't included. Amounts reported on Form 1040 line 1 excluded as foreign earned income on Form 2555. So foreign, and of course that again kind of makes sense because if it's foreign earned income, then it might be excluded from taxes for the U.S. because the point is it got taxed somewhere else, and that would typically be on Form 2555. Medicaid waiver payments you exclude from income. Again, excluded from income typically wouldn't then be included for the purposes of earned income for the credit. Pension and annuities, Social Security and railroad retirement benefits, and workers' compensation. Interest and dividends, so like the passive income, not included. So because it's not earned income, it's passive. Unemployment compensation, so not included. Scholarship and fellowship grants, except for those reported on Form W-2 and paid to you for teaching or other services. So usually grants aren't for work that's being done, so it wouldn't be included unless it was for work being done, in which case it would be reported on W-2 as with normal compensation. Non-taxable workfare payments, child support payments received, so the child support that was received, not typically earned income. Income of non-resident alien that isn't effectively connected with U.S. trade or business, or any amount received for work while an inmate in a penal institution. So obviously if you're in prison, typically the government doesn't want to include that as earned income for tax credit purposes. Rule for student spouse or spouse not able to care for self. Your spouse is treated as having earned income for any month that he or she is a full-time student. So here we have some exceptions here. So full-time, because now we're thinking, well, what if we have a married couple and one of them's basically going to school full-time? Then you would still need to pay for the child care. Wouldn't that qualify for it? Well, they're saying, well, if we have a full-time student or physically or mentally not able to care for himself or herself, your spouse also must live with you for more than half of the year. If you are filing a joint return, this rule also applies to you. You can be treated as having earned income for any month you are a full-time student. So any month you're a full-time student then. So that's could be huge because that's one of the kind of restrictions oftentimes. If a married couple, one's not, if one spouse isn't going to work, then the IRS, the typical kind of consideration under this credit would be, well, then they could take care of the child, and the expenses typically you would think would not be necessary for child care. However, if there's an exception, maybe if they're going to school, then maybe that's a good enough incentive to go to school, and you'd have to pay the child care expenses, and maybe that would qualify for an exception. So keep that in mind. You can be treated as having earned income for any month you are a full-time student or not able to care for yourself. Figure the earned income of the non-working spouse described in 1 and 2 above as shown under income limitation under how to figure the credit later. So we'll talk about calculating the credit later. This rule applies to only one spouse for any 1 month. If in the same month, both you and your spouse don't work and are either full-time students or not physically or mentally able to care for yourselves, only one of you can be treated as having earned income that month. So note, so that's a kind of a special rule. If you've got 2 people involved there and they're both full-time students, then you may not be able to qualify for both of them working at that point. And that's what you're looking for. You're looking for both of them to be working, so that then that would be justification for paying the expenses for childcare because you have two people basically working. So that's kind of, when you're looking for this credit, kind of the goal. You're kind of looking for, okay, we got two people working and therefore we're paying for the childcare and should have it be deductible or count towards this credit calculation. Full-time student, you are, so what is a full-time student? Now, of course, we've introduced that. What's a full-time student? Full-time student, you are a full-time student if you are enrolled at a school for the number of hours or classes that the school considers full-time. So you basically have to ask the school, how many credits is full-time? What is full-time? I need to make sure I'm full-time for this amount of this period of time. You must have been a full-time student for some part of each of 5 calendar months during the year. The months need not be consecutive, meaning they don't have to be in order. School. The term school includes high school, colleges, universities, and technical trade and mechanical schools. A school doesn't include on-the-job training course, correspondence school, or school offering courses only through the internet. In this presentation, we will use tax software to test the rule of you must have earned income with relation to the child and dependent care expenses credit. Here is our test 1040. We have the head of household filing status. We've got the one dependent child tax credit is qualified for. We're going to say that the $40,000 of income, $18,000 standard deduction because it's a head of household status. So head of household, $18,000, $22,000 of taxable income. Then the tax then at $2,371 calculated by the software. We have the child tax credit up top, $1,711. That's not what we're concentrating on here. We are concentrated on the child and dependent care expenses credit, and that's going to be included here. So you see there's a jump from this credit up to the $2,371. That jump is included in Schedule 3. Schedule 3, here's the $660 for the credit for child and dependent care, which is coming from Form 2441. Here's 2441 with the calculation. Now, what we're going to do is say, well, what would happen then if there was no income? If we said, all right, what if there was no income, and we say that income was gone, no income? Well, then, of course, these are based on income. The point of the credit is to allow somebody to work. So the IRS says, well, if there's no income, then clearly any expenses that we expended, we had the expenses given here, but no income reported, will not result in a credit. So we have no child tax credit. That's not what we're focusing on here. We're focusing on the child and dependent care expenses credit, but both of them are dependent on some income. We'll test some more scenarios later, but let's just say we brought it up to $10,000 for now. Say, all right, what if wages were $10,000? So we have $10,000. Notice that that is going to be less than the standard deduction, so there's no liability. There's no tax liability here. And although we have the child tax credit kind of down here in an earned income credit, we're not seeing the credit for the child and dependent care expenses. Let's bring this up, this $10,000 up over the $18,000. Let's say, well, what if it was $20,000? $20,000, and then go back to our form and say, now we've got the $20,000 income, $18,000 standard deduction, $2,000 taxable income, which is the 201 tax, and then we've got the 201 of the credit, bringing it down to 0, and then we've got these credits that will take it down below that. If we go to Schedule 3, then we see the detail of the 201 child tax credit, or sorry, child credit for child and dependent care expenses, and then the 2441 is going to show that as well. Here's the calculation for it. Now, of course, if we increase from there, we're going to say we're qualified now because we have some earned income. And then we'll discuss the effect on the credit itself. So here's the 810. We'll discuss the calculation of the amount of the credit later, but just note that, of course, we need some earned income in order to qualify for the credit at all. Note also that the earned income may be somewhere else, such as like a Schedule C. If we had our own business, that would be something that we can have earned income from. So if we had, let's say, a Schedule C, our own business, this is a Schedule C easy, but our own business, then we'd have the Schedule C attached if it was a sole proprietor, the $30,000 here, and that would be pulled over to Schedule 1, the $30,000, then pulled over to the Form 1040. So there's the $30,000 there, and then that's going to be something that will qualify us for the calculation on Schedule 3 of the credit for the child and dependent care expenses, which is also calculated on 2441. So 2441. So once again, earned income could be something other than the W-2 wages. And one common example is business income, Schedule C income. Note that Social Security income won't typically do it. So if we're getting Social Security benefits, we're getting money for Social Security benefits here, and we're going to say, okay, 30,000, that's going to be income, but you'll see that the reports aren't generated. It's not affecting us for the purposes of earned income for the calculation of the credits. In this case, it looks like not either the child tax credit or the expenses credit, because they're saying that basically Social Security, in this case, is not being counted as earned income, and we have no other earned income. Also note if we have taxable interest and dividends, which are kind of investment type of incomes typically, also not earned income and not being used, even though we have significant amount of 30,000 here, we don't have any calculation of our credit, and that's because it's not going to be considered the earned income. So it is possible for us to have some income and even taxable types of income that aren't considered to be the earned income, including the taxable and ordinary dividends, and still possibly not qualify for the calculation of our credit. Now we have a situation where we're married filing jointly. We have the one dependent. We still put the 10,000 for the credit here. However, we have the 40,000 of wages, which you would think would be over the incomes. There would be earned income. It's W-2 income, but we don't see the credit being calculated here as well. And that's going to be because we would typically need both parents to be working. And that's going to be a situation the IRS basically would say, well, if one parent isn't working and you're married, then the other parent should possibly be able to have the time to take care of the child, wouldn't need to write off the expenses then, would be kind of the justification. So if you had this same 40,000 then that was earned evenly by the two parents, we're going to say, all right, if we had one W-2 and it doesn't have to necessarily be even, but if we had 20,000 and 20,000, and we say that this is the spouse, so now we've got one W-2 applied to each, and both of them have earned income. So we'll say, all right, now we have both having earned income. It's the same 40,000 here, but now we're seeing the credit being calculated in Schedule 3, the 660, and in the 2441. So note that that's typically going to be the case, and something that's a concern sometimes, because of course a lot of times, one spouse is working and possibly the other spouse isn't working, and then if you still had expenses on top of that for child care type of expenses, then you may not qualify. So you want to have basically some income in both. Now if we go back to our scenario where we have a married couple here, we have the one dependent, and it's not calculating because the 40,000 is only being earned by one of the two spouses. In that case, we'd say, well, what if the other one was going to school full-time? And say, well, if we look at that in our data input software, we could say, here's spouse disabled or full-time student. Let's try full-time student, and then see if that changes the calc just from the tax software, just to input in the software example. And then if we go to Schedule 3, it's now back, right? The schedule is now calculating it back. So again, this isn't verifying the code or anything. This is just basically double-checking with the software, seeing how the software will interact with this, because again, the software is designed based on the tax code. So we can plug this information in, we get a feel for what's going on and the different type of scenarios that would be in place. We go to the 2441, so this has now reappeared now that we're going to say that one of the individuals was a full-time student. Now, if we say that both were full-time student and there's no income, for example, if we go back over here and we say, all right, well, now they're both full-time students and the wages are 0, well, that's probably, not gonna format here, so that's not gonna work. So, but if we had the wages for one, being a full-time student, then that could still basically qualify us for that married couple as well, according to our test scenarios within the software. In this presentation, we will go through the question of, can you claim the credit for the child and dependent care expenses credit with a flowchart format, which can be found in publication 503. So we're going to start here within the flowchart. We're going to go through the yes/no questions within the flowchart to see if we will qualify for the credit. So this is how we can kind of structure this in our mind. We kind of picture this flowchart with pictures here. Was the care for one or more qualifying persons? So we have to see if it's a qualifying person. If yes, we move on. If no, can't claim the credit. So we're going to assume yes here. Did you have any earned income during the year? So we need to have the earned income. That's going to be our second question we'll ask. If we say yes, we had some earned income, then we'll move forward. Then in no, if we have zero earned income, then typically we would say no, can't claim the credit generally. Next item, did you pay the expenses to allow you to work or look for work? So remember, that's going to be kind of the reasons for it. The expenses being paid to some type of child care in order to work or look for work is typically the rationale. If yes, then we're going to move forward. If no, we're going to say can't claim the credit. Next item, were your payments made to someone you or your spouse could claim as a dependent? So in this case, we're going to say if the answer is no, we move forward, because typically, again, you can't kind of, usually the normal scenario would say you have 2 kids and you try to pay the expenses to one kid to take care of the other kid or something like that, 2 children that are dependents. We can't really pay someone that we're claiming as a dependent for this particular credit. So if yes, if we're paying someone who is our dependent, can't typically claim. If no, we move forward. Were your payments made to your spouse or to the parent of your qualifying person who is your qualifying child and under the age 13? Again, we can't typically have that be the case. If that's the case, then we're going to say, yeah, if that's the case, then we cannot claim. And then if it's not the case, then of course, then we can move forward. Were your payments made to your child who was under the age of 19 at the end of the year? So if yes, again, can't claim because then it's going to the child under the age of 19. If no, then we'll keep moving forward. And now it gets a little bit complex here. So we're going to this item here. Are you single? If we're saying yes, we're single, we'll move this way. So we'll start this way and then we'll go to this item. Do you know the care provider's name, address, and identification number? If yes, we'll move down this way. If no, then we're going to have to go through some more questions. We'll go through that in a second. Back up here. Are you single? If the answer is no, are you filing a joint return? If yes, then we're going to go here. Do you know the care provider's name, address, identification number? And we'll move forward. Back up to this one. Are you filing a joint return? If you're not filing a joint return, do you meet the requirements to be considered unmarried? If not, then we're going to go over here. So, and again, that really relates to the kind of the restriction typically that if you're married, you can't generally file married filing separate type of return. It's kind of what that's going to. So if you're married, you got to file married filing joint typically a return. It doesn't really qualify usually for married filing separate unless there's an unusual circumstance. So going back down, and so we're following this item. Do you know the care provider's name, address, and identification number? If no, then we're going to move forward, because if we don't know those things, then can we claim the credit? We have a bit of a problem because typically we need those things. So did you make a reasonable effort to get this information? So if we did make a reasonable effort, we'll go forward. If we didn't make a reasonable effort, meaning we're trying to write off expenses and we're not telling the IRS the caretaker provider's name, address, and identification number, the IRS doesn't like that. They like to know who we're paying when we get to write off a deduction. So if we don't have that, then and we didn't do our diligence to get that, would typically mean that we wouldn't get the credit. Did you pay expenses for more than one qualifying person? And so if we're going to say no, we're going to move forward. Yes, we're going to move down this way. So if no, are you excluding or deducting at least $3,000 of dependent care benefits? If we're excluding or deducting at least $3,000 of dependent care benefits, if that's yes, you can't claim the child and dependent care credit. If no, then we'll move forward. You may be able to claim the child and dependent care credit. Of course, we can go directly here from here. Did you pay expenses for more than one qualifying person? If that's yes, then we'll move down here. You may be able to claim the child and dependent care credit, fill out form 2441. If no, we moved forward to this item. In this presentation, we will discuss the question of, are these work-related expenses with relation to the child and dependent care expenses credit? This information can be found in publication 503. Child and dependent care expenses must be work-related to qualify for the credit. Expenses are considered work-related only if both the following are true. So both of these must be true to be work-related. First item, they allow you and your spouse, if filing jointly, to work or look for work. They are for a qualifying person's care. So we talked about what a qualifying person is in a prior presentation. These two must be met in order for the expenses to be considered work-related. This is often a big issue with the married couples because if we have two individuals, then the expenses that we have that we're paying for the child care need to allow both the individuals to work. So in that case, then what if we have one situation where one spouse is working and the other is not working? Then from the IRS's standpoint, they might make the assumption that the other spouse doesn't need the expenses necessarily because they could be taking care of the child then. So that's where we have this situation where the expenses need to be there in order to allow the work to be taking place. Back to the text. Working or looking for work. To be work-related, your expenses must allow you to work or look for work. If you are married, generally both you and your spouse must work or look for work. So in the married condition, the married situation, both need to be working typically to qualify, but then we're going to look for exceptions, possibly exception if one individual is looking for work. One spouse is treated as working during any month he or she is a full-time student or isn't physically or mentally able to care for himself or herself. So for the purposes of this credit then, if they're a full-time student, if one of the married individuals are a full-time student, then possibly that could qualify for working, or if physically or mentally not able to care for himself or herself. So in that condition, then we wouldn't have the work requirement in essence, basically, or the work requirement would be fulfilled given that situation, which could make the credit more likely to be able to take the credit. Back to the text. Your work can be for others or in your own business or partnership and can be either full-time or part-time. So we could have part-time work and full-time work, which would both qualify towards it. It could be in the own business, meaning it might be on a Schedule C, sole proprietor type of business, which is owned, and that would still qualify. Work also includes activity looking for work. However, if you don't find a job and have no earned income for the year, you can't take the credit. Back to the text. An expense isn't considered work-related merely because you had it while you were working. The purpose of the expense must be to allow you to work. So notice that if just because you had an expense, if we had the child expense or some kind of child care expense, it's not enough that we were working at the same time we had the expense. It's got to be that the child care expense was for us to be able to work. That's kind of the gist or the rationale for the credit in the first place. Whether your expenses allow you to work or look for work depends on the facts below. Now, obviously, again, from a practical standpoint, you're going to ask, well, how would the IRS really know that the payments were there in order to have the child care to allow me to work or look for work? What are the types of requirements that we can actually put down and verify on those items? So let's go through some samples and some scenarios. Example 1, the cost of a babysitter while you and your spouse go out to eat isn't normally a work-related expense. So if we're just paying basically some child care for a short time to go eat or something like that, then that wouldn't typically be work-related because, of course, it wasn't given in order to go to work. That wasn't the point of the payment. Example 2, you work during the day, your spouse works nights and sleeps during the day. You pay the care of your 5-year-old child during the hours when you are working and your spouse is sleeping. Your expenses are considered work-related. And the point here is that although that one spouse is home, you have a schedule that one works at night, one works during the day. You know, if one is sleeping during that time period, then you would think that it would still be a work-related expense, even though the time schedules are night and day. So that possibly volunteer work for this purpose, you aren't considered to be working if you do unpaid volunteer work or volunteer work for a nominal salary. So if it's volunteer work, that's not typically what they're looking for because they're looking for kind of earned income. That's the point of the expenses, to allow someone to then do something to get the earned income is what they're looking for. Back to the text. Work for part of year. If you work or actively look for work during only part of the period covered by expenses, then you must figure your expenses for each day. For example, if you work all year and pay care expenses of $250 a month, $3,000 for the year. All the expenses are work-related. However, if you work or look for work for 2 months of 15 days during the year and pay expenses of $250 a month, your work-related expenses are limited to $625, which is 2.5 months times the 250. So they're basically saying you got to prorate the amount of expenses if you only worked for part of the year. Temporary absence from work. You don't have to figure your expenses for each day during a short temporary absence from work, such as a vacation or a minor illness, if you have to pay for care anyway. Instead, you can figure your credit including the expenses you paid for the period of absence. So if you have a long extended period of time of not working, then they're basically saying you got to break it out by day and figure that amount out. But if it's just basically the normal processes of work, vacation, or sick pay, then that's not the case. An absence of 2 weeks or less is a short temporary absence. An absence of more than 2 weeks may be considered a short temporary absence depending on the circumstances. So the norm 2-week vacation or 2-week absence is kind of normal, and that would basically be considered temporary, where we wouldn't have to go through this added complication. If it was more than that, still maybe it might be not necessary to go through the added calculations, but it's more likely that it would. Example, you pay a nanny to care for your 2-year-old son and 4-year-old daughter so you can work. You become ill and miss 4 months of work, but receive sick pay. You continue to pay the nanny to care for the children while you are ill. Your absence isn't a short temporary absence, and your expenses aren't considered work-related. Now this, because of course this is for a long period of time. It's not the 2 weeks. Now we're talking 4 months. That's a pretty extended period of time. So they're saying it's not qualifying for the work-related expenses and therefore the credit. Part-time work. If you work part-time, you generally must figure your expenses for each day. However, if you have to pay for care weekly, monthly, or in any other way that includes both days worked and days not worked, you can figure your credit including the expenses you paid for days you didn't work. Any day when you work at least 1 hour is a day of work. So in other words, if we have days where we're not working and we're not paying for the care, then you would typically think that we would have to figure by day and not include them. However, if we're paying those days anyways, because that's just the way we pay for the care, so we don't, for example, if we don't know which days we're going to work and we have to pay for the full week and we don't know which day we're going to be working or not working, then typically we would get the full day for the calculation of the expenses. Basically my interpretation of this. Example 1, let's look at some of their examples here. Example 1, you work 3 days a week. While you work, your 6-year-old child attends a dependent care center which complies with all state and local regulations. You can pay the center $150 for any 3 days of the week or $250 for 5 days a week. Your child attends the center 5 days a week. Your work-related expenses are limited to $150 a week. So because it's for any 3 days, we're going to say it's the $150 for those 3 days because we work 3 days. Example 2, the facts are the same as example 1, except the center doesn't offer 3-day options. So here's the example that we would expect to see. It's not just any 3 days possibly. They don't offer that option possibly. And they say the entire $250 weekly fee may be a work-related expense because they're going to say, hey, you have to pay $250 for the 5 days, and if you only use 3 of them, then okay. Well, in that situation, we'd have to say, well, now we've already paid the $250 to basically get those 3 days because we didn't know which 3 days it was going to be. So in that case, you'd get the full $250. In this presentation, we'll discuss the topic of care of qualifying person related to the child and dependent care expenses credit. This information can be found in publication 503. Care of a qualifying person. To be work-related, your expenses must be to provide care for a qualifying person. You don't have to choose the least expensive way of providing the care. So when we think about care for a qualifying person, note what they're saying is that we need to have the expenses related to something that allows us to work typically, but we don't need to then have the least expensive provider. But you can see that the IRS would probably be concerned about the level of expense or the cost of the care being provided. Back to the text. The cost of a paid care provider may be an expense for the care of a qualifying person, even if another care provider is available at no cost. So again, we don't have to really choose the cheapest option necessarily in order to qualify for the care. In other words, simply because we had possibly a free option doesn't mean we can't still choose the paid option and still qualify in many cases. Back to the text. Expenses are for the care of a qualifying person only if their main purpose is the person's well-being and protection. So it's got to be for well-being and protection of the person. Expenses for household services qualify if part of the service is for the care of qualifying persons. So we have the issue of the household services. What kind of duties are the household service? And if part of the household service is that care component, what we're concentrating on here, then it may then qualify. For more information, see household services. We'll talk about that more in depth later. Expenses not for care. Expenses for care don't include amounts you pay for food, lodging, clothing, education, and entertainment. So specifically excluded, according to this publication. However, you can include small amounts paid for these items if they are incidental to, can't be separated from the cost of caring for a qualifying person. So if they're part of kind of the package deal, then they might be included. I mean, so if you obviously went to a school or a care and they separately put out the line item for lunches that are mandatory as part of the cost, then that might be something that you'd still be able to include, even though technically they broke it out as one of these specific line items. Otherwise, see the discussion of expenses, party, work related later. So we'll talk more about that. Child support payments aren't for care and don't qualify for the credit. So that's going to be, I'm assuming, a court-mandated child support in the case of possibly a divorce or something like that isn't something that would be qualification for this credit. Education, expenses for a child in nursery school, preschool, or similar programs for children below the level of kindergarten are expenses for care. And that's, of course, going to be a big one. So if we look at the expenses when we're thinking about, does this count for care? For many people, the care of the nursery school, preschool, or similar programs for children below the level of kindergarten are expenses for care. So that's going to be a huge component where many people are eligible for this credit. Expenses to attend kindergarten or higher grade aren't expenses for care. Don't use these expenses to figure your credit. So once we get kindergarten and higher, then it's no longer the case where they're going to be there. And I think part of the rule on this, or part of the rationale of this, is below that, we don't, it's not mandatory. So it's a choice, and part of that choice might be to have care so you can basically work, which is the point of the credit. Above that, then the schooling is usually generally mandatory, and therefore the primary purpose, at least in that case, or according to the law, would be that they have to go there, and it's not there. They're not going there in order to facilitate work, although it might serve that function as well. Back to the text. However, expenses for before or after school care of a child in kindergarten or higher grade may be expenses for care. So if they're in the after school program, for some reason, some type of after school or before school program that allows someone to work and go to the work, then maybe that would qualify. Summer school and tutoring programs aren't for care. So the traditional summer school and tutoring aren't typically for care because, again, the goal, if it's tutoring, you would think that if the goal isn't possibly just for someone to go to work, but, and I'm reading this into the code, this is my interpretation, but for the advancement of the student, the well-being of the student, rather than just to have caretaking for work. Back to the text, example 1. You take your 3-year-old child to a nursery school that provides lunch and a few educational activities as part of its preschool child care service. The lunch and educational activities are incidental to the child care, and their cost can't be separated from the cost of the care. You can count the total cost when you figure the credit. So in this case, I mean, you might ask, well, what's the big deal there on that? Well, they're saying as part of the package deal that they broke out individually the fact that they have a lunch and some other activities in there, which if they were given to separately, if we paid for them separately, or if that was the main thing we're paying for, then it may not qualify. But because they're just part of the caretaking and they're incidental, they're not the material part, then we just take the whole amount. Example 2. You place your 10-year-old child in a boarding school so you can work full-time. Only the part of the boarding school expense that is for the care of your child is a work-related expense. So in a boarding school situation, only the part related to that's for work-related. You can count that part of the expense and figure in your credit if it can be separated from the cost of education. You can't count any part of the amount you pay the school for your child's education. So education isn't the purpose here, although the purpose here is, of course, to allow someone the ability to work. That's the point of the credit. Care outside your home. You can count the cost of care provided outside your home if the care is for your dependent under age 13 or any other qualifying person who regularly spends at least 8 hours each day in your home. Dependent care center. You can count care provided outside your home by dependent care center only if the center complies with all state and local regulations that apply to these centers. And when you go to the center, of course, you want to ask about that and ask about the qualifications and make sure you have the information. And they're typically the ones that are qualified will be readily providing that information. It's usually a dependent care center is a place that provides care for more than 6 persons other than persons who live there and receives a fee, payment, or grant for providing services for any of those persons, even if the center isn't run for profit. Camp. So now we're at a camp. The cost of sending your child to an overnight camp isn't considered a work-related expense. The cost of sending your child to a day camp may be work-related expense even if the camp specializes in particular activity, such as computers or soccer. So camp's going to be one of those areas. What's the purpose of the camp? If part of the purpose is to have a work-related, put the child in camp so that you can have a work-related, go to work, basically, then it may qualify. You would think that would then be during the day if you basically work during the day. And even if it's a specialized camp for like computers or soccer or something like that, it may still qualify. Transportation. If a care provider takes a qualifying person to or from a place where care is provided, that transportation is for the care of the qualifying person. So now we're saying, well, what happens if, the care provider drives someone there? Well, then once the driving, then we would think then would be part of the expenses as well in that case, because that could be part of what is needed for work-related activities. So this includes transportation by bus, subway, taxi, and private car. However, transportation not provided by a care provider isn't for the care of a qualifying person. Also, if you pay the transportation costs for the care provider to camp to come to your home, that expense isn't for care of a qualifying person. So if you break out basically the cost of their travel time, then maybe that wouldn't be included. And again, that kind of gets a little bit technical on how you come up with your fee of how much you're paying them. But anyway, back to the text. Fees and deposits. Fees you paid to an agency to get the services of a care provider, deposits you paid to an agency or preschool, application fees, and other indirect expenses are work-related expenses if you have to pay them to get care, even though they aren't directly for care. However, a forfeited deposit isn't for the care of a qualifying person if care isn't provided. Example 1, you paid a fee to an agency to get the services of the nanny who cares for your 2-year-old daughter while you work. The fee you paid is work-related expense. That seems fairly straightforward. Example 2, you placed a deposit with the preschool to reserve a place for your 3-year-old child. You later sent your child to a different preschool and forfeited the deposit. The forfeited deposit isn't for care and therefore not work-related. So you kind of put the deposit there to save the place, yet it didn't happen. So then you forfeited the deposit to go somewhere else. In this presentation, we'll discuss the concept of household services related to child and dependent care expenses credit. This information can be found in Publication 503. Household services. Expenses you pay for household services meet the work-related expense test if they are at least partially for the well-being and protection of a qualifying child. Let's go through that one more time. Expenses you pay for household services, so we're paying these for household services, meet the work-related expense test. That's what we're looking for. We want to meet that test. so that we can possibly have this credit. If they are at least partially for the well-being and protection, so well-being and protection of the qualifying person, a qualifying person. So those are going to be some of the key terms, definitions we need to look into. Back to the text. Definition. Household services are ordinary and usual services done in and around your home that are necessary to run your home. They include services of a housekeeper, maid, or cook. However, they don't include the services of chauffeur, bartender, or gardener. Housekeeper. In this publication, the term housekeeper refers to any household employee whose services include the care of the qualifying child. So the housekeeper, by definition, in this publication includes the care of the qualifying child. Expenses partly work-related. If a part of an expense is work-related for either household services or the care of the qualifying child, and part is for other purposes, you have to divide the expenses. So we're going to say, okay, what's the amount that's going to be the work-related amount versus the non-work-related? To figure your credit, count only the part that is work-related. So only the work-related, of course, would qualify for this particular credit, given that's the objective of the credit, to be able to work with it. However, you don't have to divide the expense if only a small part is for other purposes. So if it's basically kind of immaterial part, then you don't have to divide it out. Example, you pay a housekeeper to care for your 9-year-old and 15-year-old child so you can work. The housekeeper spends most of the time normal housekeeping work and spends 30 minutes a day driving you to and from work. You don't have to divide the expenses. So they're saying don't have to divide the expenses in this case. You can treat the entire expense of the housekeeper as work-related because the time spent driving is minimal. So they're basically saying, hey, there's some time that's not, that typically wouldn't qualify, but since it's small, kind of immaterial, then you don't have to break that out. Nor do you have to divide the expense between the two children, even though the expenses are partially for a 15-year-old child who isn't a qualified person. So note we have this situation where we have two kids. One is not qualified, the other is. They're saying don't have to break it out for the 15-year-old. Because the expense is also partially for the care of the 9-year-old child who is a qualifying child. However, the dollar limit discussed later is based on one qualifying person, not two. Meals and lodging provided for housekeeper. If you have expenses for meals that your housekeeper eats in your home because of his or her employment, count these as work-related expenses. If you have extra expenses for providing lodging in your home to the housekeeper, count these as work-related expenses. So those are going to be, because they're part of basically the pay in this case, so they would be work-related and therefore probably count towards the calculation of the credit. Example, to provide lodging to the housekeeper, you move to an apartment with an extra bedroom. You can count the extra rent and utility expenses for the housekeeper's bedroom as work-related. So clearly in that case, they're basically saying, hey, this extra room that we have here that we're now paying more for is part of the compensation and therefore work-related. However, if the housekeeper moves into an existing bedroom in your home, you can count only the extra utility expenses as work-related. So if we already have the home, they're saying, and we have an extra bedroom that no one's using, now someone's using it, the idea here is that there's no added expense for basically the rent anymore. However, there could be added expenses for the utilities in that case. Taxes paid on wages. The taxes you pay on wages for a qualifying child and dependent care services are work-related expenses. For more information on household employers' tax responsibilities, see Do you have household employees later. Payments to relatives and dependents. You can count work-related payments you make to relatives who aren't your dependents. So if they're a dependent, then you're typically out of luck, but if they are not a dependent, may still qualify, even if they live in your home. However, don't count any amounts you pay to one. So this is the amounts that we don't count. So don't count any amounts you pay to one, a person whom you or your spouse is filing jointly can claim a dependent. So typically not someone that you can claim a dependent for. Two, your child who was under age 19 at the end of the year, even if he or she isn't your dependent. So if they're under 19, then typically they would be your dependent, but for whatever reason, if they're not qualified for whatever reason, you still wouldn't include them. Next item, number 3, a person who was your spouse anytime during the year. And that seems pretty self-explanatory. If they were, you probably would be filing a joint return, or maybe the divorce happened before the end of the year, which would be kind of an unusual situation. But in any case, they wouldn't qualify. 4, the parent of your qualifying person, if your qualifying person is your child under the age of 13. In this presentation, we will discuss the topic of filing status with regard to child and dependent care expenses credit. This information can be found in publication 503. What's your filing status? Generally, married couples must file a joint return to take the credit. However, if you are legally separated or living apart from your spouse, you may be able to file a separate return and still take the credit. So in other words, this is going to be that exception where you can take this credit for just about any type of filing status, but mostly not married filing separately. So if you're married filing separately, then typically there's going to be a restriction from taking the credit. So in other words, if you're married, you usually only have 2 options most of the time, and that is to file either jointly, the common option, the normal option, or to file married filing separate, and that's going to be kind of the separation or the more unusual type of choice. And there's restrictions normally with that unusual choice. And a lot of times the IRS will restrict credits related to it because they want to lower the likelihood of people filing separately as married filing separate simply to maximize the credits, because that can get quite complicated in that case. In other words, it's also difficult to go from married, if we're legally married, to filing separate in any of the other types of formats, such as single or head of household. Typically can't usually jump back and forth between those two if you're legally married. So back to the text. Legally separated. You aren't considered married if you are legally separated from your spouse under a decree or divorce or a separate maintenance. You may be eligible to take the credit on your return using head of household. So now we're talking about, of course, if you're legally separated in some way, whatever that may be. Now we're going to say, okay, we're legally separated, therefore we're no longer required to file either married or married filing separate, but legally separated, and therefore the filing status would probably be head of household, given the fact that we're claiming this credit, which means we probably have a child, which would have head of household filing rather than a single filing status. So single or head of household typically with a qualifying child. Back to the text. Married and living apart. You aren't considered married and are eligible to take the credit if all the following apply. 1. You file a return apart from your spouse. 2. Your home is the home of a qualifying person for more than half the year. 3. You pay more than half the cost of keeping up your home for the year. 4. Your spouse doesn't live in your home for at least 6 months of the year. The IRS is therefore saying that for taxes, if these 4 things apply, you aren't considered married, at least for the purposes of taxes, and therefore can file a separate return, possibly not legally separated. You may also be able to take the child and dependent care credit even though you aren't legally separated and you file a separate return. Let's consider some examples. Example 1. Amy separated from her spouse in March. She isn't separated under a decree of divorce or separate maintenance agreement and uses the married filing separate filing status. Amy maintains a home for herself and Sam, her disabled brother. Sam is permanently and totally disabled and unable to care for himself. Because Sam earns $5,600 in interest income, Amy can't claim him as a dependent. His gross income is greater than $4,150. That was a limit that we had in previous presentations. And because Amy isn't able to claim Sam as a dependent and she is still married as of the end of the year, she can't use the head of household filing status. So here we have that situation where they're saying she doesn't qualify to file as not, the only 2 options under married would typically be married filing joint or married filing separate. And they're saying that they don't qualify to file as not married, which would be the head of household probably status or a singles type status. Let's continue to the text. Amy's filing status is married filing separately, and Sam qualifies as a qualified person for the child and dependent care credit. So in this case, that's going to be a special circumstance, in which case Amy's filing status is married filing separate, unusual for that to be an accepted filing status to take the credit in this case. Because of the following facts, Amy is able to claim the credit for the child and dependent care expenses even though Amy uses the married filing separately filing status. Amy didn't live with her spouse for the last 6 months of the calendar of the year. She has maintained a home for herself and Sam, a qualifying individual, since she separated from her spouse in March, and she maintains her own household and provides more than half of the cost of maintaining that home for her and Sam. Amy pays an adult daycare center to take care of Sam to allow her to work. So that's, of course, the expenses we're thinking about for this credit. Example 2. Dean separated from his spouse in April. He isn't separated under a decree of divorce or separate maintenance agreement. He and his spouse haven't lived together since April, and Dean maintains his home and provides more than half the cost of maintaining that home for himself and his daughter, Nicole, who is permanently and totally disabled. Because Nicole is married and files a joint return with her husband, who is away in the military, Dean can't claim Nicole as dependent and therefore can't use the head of household filing status. Dean's filing status is married, filing separately, and Nicole qualifies as a qualified person for the child and dependent care credit. Recapping the circumstances, Dean didn't live with his spouse for the last 6 months of the year. He has maintained a home for himself and Nicole, a qualifying individual, since he separated from his spouse in April. He maintains his own household and provides more than half of the cost of maintaining that home for him and Nicole. Dean pays a daycare provider to care for Nicole to allow him to work, which is, of course, the expenses that we're considering here. Cost of keeping up a home. The costs of keeping up a home normally include property tax, mortgage interest, rent, utility charges, home repairs, insurance on the home, and food eaten at home. The costs of keeping up a home don't include payments for clothing, education, medical treatment, vacations, life insurance, transportation, mortgage, principal. So when we're considering the cost of home to see whether or not the cost of home can be included in some way in the expenses, of course, these are things that are going to be specifically excluded. Typically, these are the things that we would typically think of. So if we're thinking about the costs of home, and if we have home and board, if someone lives in the home as part of the payment for them, then property taxes include, notice it's the mortgage interest, not the mortgage, not paying the loan typically, but the interest portion. If you're renting, then the rent on the place. Utility charges, which would be the gas, electric, and whatnot, repairs, and insurance on the home. They also don't include the purchase, permanent improvement, or replacement of property. So if we're purchasing new property, that's going to not typically be the cost. Permanent improvement. So if we made a new addition to the home, again, unless the addition was specifically for the care services, then if it was just an addition to the home, then the cost of the addition won't typically be something that would be included in the expense. Or replacement property. For example, you can't include the cost of replacing a water heater. However, you can include the cost of repairing a water heater. And okay, let's keep going. Death of spouse. If your spouse died during the year and you don't remarry before the end of the year, you generally must file a joint return to take the credit. If you do remarry before the end of the year, the credit can be claimed on your deceased spouse's own return. In this presentation, we will discuss the topic of the care provider identification test with relation to the child and dependent care expenses credit. Information can be found in publication 503. Care provider identification test. You must identify all persons or organizations that provide care for your child or dependent. We can use Form 2441 Part 1 to show this information. Here's an example of Form 244. This is the child and dependent care expenses. We have Part 1 up top. We've got the organization, which is called organization. Then we have the address here, and then the identification number, and then the amount paid. So note, when you go to an organization, they're probably going to have the identification number. And if you go to an organization that deals with this a lot, and this is their business, they probably have that readily available and will provide that to you. But make sure that we have this information so that you can easily fill out the tax return. Note that it may be in the form of a social security number or an EIN number, depending on the organization we're dealing with. If we're dealing with an organization, it's probably in the format of an EIN number, which is a employee identification number. If we're dealing with an individual, then it's going to be in that social security number format typically. Back to the text. If you don't have any care providers and you are filing Form 2441 only to report taxable income in Part 3, enter none in line 1, column A. Information needed. To identify the care provider, you must give the provider's name, address, and taxpayer identification number. So again, we could see that here. The name would be here. We've got the address and the taxpayer identification number. Back to the text. If the care provider is an individual, the taxpayer identification number is his or her social security number or individual taxpayer identification number. So that would typically, we'll see a social security number type format. Even if they are an individual, they may want to get or may have an identification number, an EIN number. If the care provider is an organization, then it is the employer identification number, EIN number. So most of the time, it'll typically be an EIN number type of format, an employee identification number. You don't have to show the taxpayer identification number if the care provider is a tax-exempt organization. So if they're tax-exempt, then we don't need the number, such as a church or school. In this case, enter tax-exempt in the space where Form 10441 asks for the number. So it might look something like this, tax-exempt. Back to the text. If you can't provide all the information or the information is incorrect, you must be able to show that you used due diligence, discussed later, in trying to furnish the necessary information. So if we don't know what the address is or the EIN number, then the IRS is going to be skeptical, of course, of giving a credit if we don't have that information. They want to know who we paid it to basically take the credit typically. But so we have to show basically due diligence that we really tried to get the address and the identification number. Maybe they closed or something like that and we couldn't get it. So getting the information. You can use Form W-9, Dependent Care Providers Identification and Certification, to request the required information from the care provider. If you don't use Form W-10, you can get the information from one of the other sources listed in the instructions for Form W-10, including. And so you can look up W-10 on the IRS website, irs.gov. Look up the W-10 information and also probably instructions from it as well and go from there. So number 1, a copy of the provider's social security card. So that's one item we could use for the information. The number 2, a copy of the provider's completed Form W-4, employees withholding allowance certificate if he or she is your household employee. So if we're talking about a household employee, then they should be our employee. We should have recorded them as an employee and therefore had them fill out a W-4 form, which is what typically you have at a new job. And that should have the required information, including social security number and address. 3, a copy of the statement furnished by your employer if the provider is your employer's dependent care plan. So if it's through the employer, then the employer might have that information. 4, a letter or invoice from the provider if it shows the necessary information. It might be the case if we have a provider that this is what they do, some type of care that would typically often qualify, that they provide this information actually on the invoice, which would be nice because they know everybody's going to need it, at the end of the year, so that would be good. So records, you should keep this information with your tax returns. Don't send Form W-10 or other documents containing this information to the IRS. Note that this information, you want to have this information in case the tax return, the IRS has a question. If they come back and say, hey, we got a question about the address, the identification number, or this or that, then we want to know where we got it. Because if we have the wrong identification number or something like that, then we want to say, hey, this is where we got it from, and maybe we have the right, maybe we just wrote it down wrong, or or maybe we at least have the information regarding it, and we could show try to show, at least hopefully show due diligence for that. Due diligence. If the care provider information you give is incorrect or incomplete, your credit may not be allowed. So they may not allow the credit, which is of course what we're going for here, if it's not complete. So however, if you can show that you used due diligence in trying to supply the information, you can still claim the credit. So in those situations where you say, hey, I did everything I basically could to try to get the information, I've done what I can to get the information, I think it's a legitimate claim, then you've got to show what they would call the due diligence. You can show due diligence by getting and keeping the provider's completed Form W-10 or one of the other source of information just listed. Care providers can be penalized if they don't provide this information to you or if they provide incorrect information. So if the provider basically doesn't give the information for whatever reason, maybe their number no longer exists, so they don't have a number or something like that, then and they were advertising that they did or saying that they had it or something like that, then they'll probably get into trouble at some point in time, because most of the people that are having the service might want the number for the credit. So you need to keep the information basically on hand. So provider refusal. If the provider refuses to give you the identification number, you should report on Form 2441 whatever information you have, such as the name and address. Enter see attached statement. So then we'll have an attachment. You can say, here's the name and address, this is what we have, and then attach a statement to the tax return in the columns calling for the information you don't have. This attached statement explaining that you request the information from the care provider, but the provider didn't give you the information. So we're basically just telling the IRS, hey, look, here's what we have. We don't have the number. This is what I did. I tried. Basically have a note on the IRS and we haven't been able to get it. Be sure to write your name and social security number on this statement. The statement will show that you used due diligence in trying to furnish the necessary information. U.S. citizens and resident aliens living abroad. If you are living abroad, your care provider may not have and may not require to get a U.S. taxpayer identification number, for example, a social security number or EIN. So if you're not living in the U.S., obviously they may not have these numbers that we need in the U.S. for identification purposes if they're outside the U.S. If so, enter LAFCP, living abroad foreign care provider, if the space for the care provider taxpayer identification number in the space for the care provider's taxpayer identification number. In this presentation, we will discuss how to figure the child and dependent care expenses credit. This information from publication 503. How to figure the credit. Your credit is a percentage of your work-related expenses, so that's one term we're going to have to define. Your expenses are subject to earned income limit, so we're going to have an earned income limit we'll have to look into, and a dollar limit. A dollar limit we'll have to look into. The percentage is based on your adjusted gross income, your AGI adjusted gross income. We know that the adjusted gross income is going to be the line 7. So if we go to our tax return, line 7 will be the adjusted gross income. We have the income up top, and then we have the adjustments above the line. Adjustments are on Schedule 1 now, so these would be the above the line adjustments. And then if we go back to the 1040, we would have line 7 being the adjusted gross income, this being a common figure to basically have the income limitation type calculations or types of credits and other deductions that are based on some kind of income level. Figuring your work-related expenses. To figure the credit for 2018, work-related expenses count only those you paid by December 31st, 2018. So we're on more of a cash basis type of system, must have paid, in other words, must have actually paid them by the end of the year, December 31st, 2018. Expenses prepaid in the earlier year. If you pay for services before they are provided, you can count the prepaid expenses only in the year the care is received. Claim the expenses for the later year as if they were actually paid in that later year. So what does that mean, and why are they getting confusing like this? Let's try to tell a story of what the tax code probably developed in this format as of. We're saying that, hey, everything has to be actually paid on a cash basis because the tax code likes that, because they can actually see the tax payment. That's an easy thing to trace basically in an audit. we can imagine what would happen then under those circumstances. We might say, why don't I pay all of 2019 maybe in December 31st of 2018? In other words, let's prepay everything in this year at the end of the year for next year's services, and then I'd get to write them off in 2018 because they were paid. Well, then the IRS is going to say, well, if there's a prepayment, we're not going to allow you to do that in this case. So now they say it's a cash basis. Typically we pay for the service, or oftentimes we pay for the service when it happens or after it happens. But in the case where we prepay, then the IRS is saying, well, you can't do that because most likely the reason for the law is that they're suspicious that people will then have a large prepayment at the end of the year for the following year to take the deduction and kind of abuse that system. So in the case where you pay for the services before you get the services, then we have more of an accrual type system where it says if you pay for services before they are provided, you can count the prepaid expenses only in the year the care was received. So if you prepaid them in December 31st, but the care wasn't received until January or all of 2019, not in 2018, count the prepaid expenses only in the year the care was received, which in that case would be 2019. Claim the expenses for the later year as if they were actually paid in the later year, which is more of an accrual type basis. Expenses not paid until the following year. Don't count 2017 expenses that you paid in 2018 as work-related expenses in 2018. You may be able to claim an additional credit for them on your 2018 return, but you must figure it separately. See payments for prior year's expenses under amount of credit later. So, tip: if you had expenses in 2018 that you didn't pay until 2019, you can't count them when figuring 2018 credit. You may be able to claim a credit for them on your 2019 return. So that's going to be the other way, not a prepayment type of situation, but if we had an expense in 2018, so the work was done, we incurred the expense because the daycare was done, but we didn't actually pay it until 2019, well, that's a situation that we didn't pay it within the tax year 2018. It wasn't prepaid, and therefore we're more on a cash basis than on the accrual basis, and we can't take the credit in 2018, may be able to take it in 2019. Back to the text. Expenses reimbursed. If a state social security agency pays you a non-taxable amount to reimburse you for some of your child and dependent care expenses, you can't count the expenses that are reimbursed as work-related expenses. So obviously, and this makes kind of sense, obviously, if we were to have payments that we're saying are going to go towards this credit, and then we got reimbursed for them, well, obviously then we didn't really have the expenses, and the tax code was said you can't include those costs if you got reimbursed for them. Example: you paid work-related expenses $3,000. You are reimbursed $2,000 by a state social security service. You can use only $1,000 to figure the credit. So obviously you paid $3,000, got $2,000 back, you only get the $1,000 that would actually count towards the credit. Medical expenses. Some expenses for care of qualifying persons who aren't able to care for themselves may qualify as work-related expenses and also as medical expenses. You can use them either way, but you can't use the same expenses to claim both a credit and a medical expense deduction. So no, medical expenses are one of those expenses that could possibly go on another schedule, possibly itemized deductions, but there's big limitations to them oftentimes. So in certain circumstances, you may then be able to decide whether or not it should be included here or in some other location based on the biggest benefits you might get for them. If you use these expenses to figure the credit and they are more than the earned income limit or the dollar limit discussed later, you can add the expense to your medical expenses. However, if you use your total expenses to figure your medical expenses deduction, you can't use any part of them to figure your credit. For information on medical expenses, see publication 502. You can find that on the irs.gov. Take a look at publication 502, pub 502, medical and dental expenses. Caution: amounts excluded from your income under your employer's dependent care benefits plan can't be used to claim the medical expense deduction. In other words, if it was taken out of your income and so it's not part of taxable income, then it's not going to be something that you should be able to include either, because the income related, that wasn't taxable. So it was taken out of your income and not included as income, as taxable income. Dependent care benefits. If you receive dependent care benefits, your dollar limit for purposes of the credit may be reduced. See reduced dollar limit later. But even if you can't take the credit, you may be able to take an exclusion or deduction for the dependent care benefits. Dependent care benefits. Dependent care benefits include, number 1, amounts your employer paid directly to either you or your care provider for the care of your qualifying person while you work. So notice the dependent care is typically something we're talking about that was paid by the employer. Number 2, the fair market value of care in a daycare facility provided or sponsored by your employer. So note, you might have a situation where you are working somewhere and they provide a daycare service to help out their employees. Well, that's going to be some type of benefit, and we might not know what the cost is because maybe they provide that for the employee. Well, then it would be the fair market value. What is that? You'd have to look at comparable services within the location to kind of figure out what is the fair market value, what's the market rate if you were to go somewhere else for that. 3, pre-tax contributions you made under a dependent care flexible spending arrangement. Your salary may have been reduced to pay for these benefits. If you received benefits as an employee, they should be shown on box 10 of your W-2. So if you check your W-2 and you take a look at box 10, there's typically going to be instructions as well on the back of the W-2, hopefully, that'll give you some explanation on that box 10 form W-2. Wage and tax statement. See statement for employee later. Benefits you received as a partner should be shown in box 13 of Schedule K1. So if you're talking about a K1 for a partnership agreement, you have a partnership, then it should be on box 13 of the K1. It's kind of like the income type reporting document for a partnership. Enter the amount of these benefits on Form 2441, Part 3, line 12. Exclusion or deduction. If your employer provides dependent care benefits under a qualified plan, you may be able to exclude these benefits from your income. Your employer can tell you whether your benefit plan qualifies. To claim the exclusion, you must complete Part 3 of Form 2441. Here's a quick look of Part 3, 2441 Dependent Care Benefits. So, Part 3, 2441, quick look. Back to the text. If you are self-employed and receive benefits from a qualified dependent care benefit plan, you are treated as both employer and employee. So this is the case when you're self-employed and you have something like a Schedule C income, then you're both the employer and the employee in that case, because you're the employer because it's your business, and you're the employee because you're probably, as a sole proprietor, one of the the main worker of the employee. So the IRS considers you both in those cases. Therefore, you wouldn't get an exclusion from wages. Instead, you would get a deduction on Schedule C, Form 1040, line 14. So here's the Schedule C. It's a profit and loss for a business. We would be reporting our business income here. Then we would have the line 14, which is the employee benefit program. That would be an expense lowering the taxable income. The taxable income, the net income in essence, or the business income would be lowered. And then that amount would be going to ultimately to the 1040 and ultimately included in the total income number. Schedule E, Form 1040, line 19 or 28. Schedule E, similar situation, that's going to be for rental income. Or Schedule F, that's going to be farm income, line 15. To claim the deduction, you must use Form 2441. The amount you can exclude or deduct is limited to the smallest of 1. The total amount of dependent care benefits you received during the year, or 2. The total amount of qualified expenses you incurred during the year. 3. Your earned income. 4. Your spouse's earned income, or $5,000, $2,500 if married, filing separately. Let's break that down again. The amount you can exclude or deduct is limited to the smallest of the total amount of dependent care benefits you received during the year, either the amount you got or the total amount of qualified expenses you incurred during the year. So if you received more than the expenses than you incurred, then you're limited to the smallest of, or your earned income. So you can't have more than your earned income. Your spouse's earned income. So notice what we're not taking here is the two earned incomes combined. We're taking one spouse and the other spouse's earned income. It got to be the below that, one or the other, the smaller of the two. And then 5,000 or 2,500 if married filing separately. And then there's the dollar limit. The definition of earned income for the exclusion or deduction is the same as the definition used when figuring the credit, except that earned income for the exclusion or deduction doesn't include any dependent care benefits you received. Tip: you can choose to include your non-taxable combat pay in earned income when figuring your exclusion or deduction, even if you choose not to include it in earned income for the earned income credit or credit for child and dependent care expenses. So once again, we got that combat pay, very flexible thing to have. Statement for employee. Your employer must give you a Form W-2 or similar statement showing in Box 10 the total amount of dependent care benefits provided to you during the year under a qualified plan. The employer will also include any dependent care benefits over $5,000 in your wages shown on Form W-2, Box 1. Effect of exclusion on credit. If you exclude dependent care benefits from your income, the amount of the excluded benefits, 1, isn't included in your work-related expenses and reduces the dollar limit discussed later. In this presentation, we will take a look at the earned income limit related to the child and dependent care expenses credit. This information can be found in publication 503. Earned income limit. The amount of work-related expenses you used to figure your credit can't be more than 1. Your earned income for the year if you are single at the end of the year, or 2. The smaller of your or your spouse's earned income for the year if you are married at the end of the year. So note that we have to separate the income between the two in this case to be able to test if married who had the income. And that's a little bit unusual for a married filing joint return, where we basically think of all income as basically from one individual. But for this particular credit, because we're trying to break out and see the credit for people that are having the care in order to work, they need to know who earned the income, even though it's not really broken out on line 1 or the first page of the 1040. For example, here is our example test 1040. We have a married filing joint return. We have the one dependent. Scrolling down, we have 40,000 represented in wages. Now, of course, on page 1 of the 1040, we can't break out. We don't see here who earned it. Did the husband or wife earn it? Which spouse earned this? Normally, it wouldn't really matter for most cases. But of course, for this particular credit, it does. So if we scroll down, then we could see in this case, we have the 24,000 standard deduction. That is for married filing joint. We have the 16,000 taxable income, then the 1,603 of the tax. We're concerned with the credit, which is included in this item, line 12. It's also on Schedule 3 at 330 currently, and it's going to be on Form 2441. If we scroll down 2441, we can see that the qualified expenses are 1,500, and it's breaking out between 4 and 5. So enter the earned income, so see instructions, 30,000, and then line 5 says, if married filing joint, enter your spouse's earned income, which is the 10,000. Now, of these two, basically, then line 6 is taking the smaller of line 3, 4, and 5, which happened to be line 3. But we can imagine a situation where the scenario is different. For example, if the qualified expenses are the 10,000, then line 3 is limited to 3,000 because we had one dependent. And now we're going to say that the earnings for one spouse was 30,000 and the earnings for the second spouse was 2,000. So 3,000, 30,000, and 2,000 for a total, if we go to the 1040, earnings, W-2 earnings, we're just saying here, are 32,000. So it's being broken out. That 32 is being broke out on this 2441 as 30,000 from one spouse, 2,000 for the other. Line 6 then taking the lower of these three numbers, the limit of 3,000, which is just a dollar limitation. That dollar limitation being higher than the earned income of one of the spouses and therefore being limited to the earned income of one of the spouses. Back to the text. Earned income for the purpose of figuring the credit is defined under "you must have earned income" earlier. Tip: for purposes of item 2, use your spouse's earned income for the entire year even if you were married for only part of the year. So in other words, if you got married towards the end of the year, then that basically, usually for most purposes, that means you're going to file the return as if married for the entire year typically. If you're going to have married filing joint, then you're going to file for the entire year even if you got married, say, in December. Example: you remarried on December 1st. Your earned income for the year was $18,000. Your new spouse's earned income for the year was $2,000. You paid work-related expenses of $3,000 for the care for your 5-year-old child and qualified to claim the credit. The amount of expenses you use to figure your credit can't be more than $2,000, the smaller of your earned income or that of your spouse. So in this case, of course, again, the $18,000 or the $2,000, we have to break out on the 1040. In this case, if we were to see the 1040, then the sum of those two would be here on the 32,000 would then be the sum of those two, or in this case, 20,000. I believe this is basically the scenario here. I didn't say they were married at the end of the year, but we'll say they were married at the end of the year. So we have the wages 20,000, our 2441 then. We have 3,000 that we're saying were the total expenses that were paid, the amount paid, the qualifying expenses. Then of course we have that 3,000 and then the limit being the 3,000 for the one child, or the smaller of the earned income between the two spouse. The one is 18,000, the other is 2,000. Therefore, the limit is going to be the 2,000 in this case. Back to the text. Separated spouse. If you are legally separated or married and living apart from your spouse as described under "what's your filing status" earlier, you aren't considered married for purposes of earned income limit. Use only your income in figuring the earned income limit. So if you're separated, then we would obviously not be looking at the spouse's income for the limitations. We would just be using our income. Surviving spouse. If your spouse died during the year and you file a joint return as a surviving spouse, you may, but aren't required to, take into account the earned income of your spouse who died during the year. So that's kind of an unusual situation, because you can imagine a situation where the spouse didn't make money, that much money because of death during the year. So then there could be limitations that would not be the case had that special situation not occurred. So you might have some more optionality for that case then. Community property laws. Disregard community laws when you figure the earned income for this credit. So the community property laws, they're saying, basically aren't going to change the way the calculation will work for the purposes of this credit. Self-employment earnings. If you are self-employed, include your net earnings in earned income. For purposes of the child and dependent care credit, net earnings from self-employed generally means the amount from Schedule SE, either Schedule A or Schedule B, line 3, minus any deductions for self-employment tax on Schedule 1, Form 1040, line 27, Form 1040 NR, line 27. Include your self-employment earnings in earned income, even if they are less than 400 and you didn't file Schedule SE. Let's see if we can break that down a bit. Here's our test 1040. Once again, we have the married taxpayers. In our test 1040, we have the one dependent. Now we're saying that they have a Schedule C now, which would be business income. So one of our spouses now has a Schedule C. We just have a Schedule C EZ. And let's say that they earned $18,000 on the Schedule C. You would think that that would just be the amount. You take the amount from Schedule C and have that as basically one of the earnings of one of the spouses, then go into this form 2441, and we had one spouse that had the 2,000, and the other, you're like, wait, it's not the 18,000. They put this funny 16,728 here. Why is that? For some reason, they're not taking the net income from the Schedule C here, or it's also reported on the Schedule 1, 18,000, but taking it from the Schedule SE. And that's basically self-employment. So anybody that has a Schedule C typically has to pay Social Security, Medicare, self-employment tax. And part of the calculation for the self-employment is line 4 here, which is to multiply line 3 by 92.35. That's where that 623 is coming from. So basically you're taking the net income, but then we're not taking the net income directly from the Schedule C, but going over to the self-employment tax schedule, and that is the number that's being used, the 623, to then pull over to the 2441 for purposes of the 2441 for purposes of the child and dependent care expenses. You can also calculate that by taking line 3, which is this 18,000, which is the way it's saying in the text here, minus, if you go to Schedule 1, the amount of the deductible amount here, which is this 12. So this is the 1272, and that'll give you that 16,728 as well. That is going to be reported on the 2441, the 16,728. Back to the text. Clergy and church employees. If you are a member of the clergy or a church employee, see instructions for Form 2441 details. A statutory employee, if you file Schedule C, Form 1040, or CEZ, Form 1040, to report income as a statutory employee, also include as earned income the amount from line 1 of that Schedule C. So those are pretty special conditions. We won't go into those. Net loss. You must reduce your earned income by any net loss from self-employment. So it is possible to have a net loss type situation as well. Optional method if earnings are low or a net loss. If your net earnings from self-employment are low or you have a net loss, you may be able to figure your net earnings by using the optional method instead of the regular method. See Publication 334 Tax Guide for Small Business for details. If you use the optional method to figure your net earnings for self-employment tax purposes, include those net earnings in your earned income for this credit. In this case, subtract any deduction you claimed on Schedule 1, Form 1040, line 27, or Form 1040 NR, line 27, from the total of the amounts on Schedule SE, Section B, line 3, and 4B to figure your net earnings. So this will be the optional method, not typically something that would be used, but if you're in that particular situation, something that you could look into if you have basically the net loss might be something to consider. Next, back to the text. You or your spouse is a student or not able to care for yourself. Your spouse who is either a full-time student or not able to care for himself or herself is treated as having earned income. His or her earned income for each month is considered to be at least $250 if there is one qualified person at home, or at least $500 if there are two or more. So let's go back to our 1040 and say that we have $30,000 for one spouse, but no other work for the other spouse. And then if we go to our 2441, we're going to say that we had $10,000 of expenses, but we say that one of the spouses was a full-time student. So if we say for 12 months, full-time student for 12 months, and then we go back to our form and say, well, what's that going to do? Well, now we see that we have the 3,000 qualified expenses, 3,000 on the cap. Then we have the 30,000 for the one spouse, and the other is at 3,000, right? So if we take that 3,000 and say, all right, where did that come from? It's 3,000 because we had no wages for that employee. We just said that they were a student for 12 months, full-time student for 12 months, and they calculated 3,000 for the earned income. Okay, so that means, well, 3,000 divided by 12 months, they basically gave 250 credit for the 12 months of earned income, even though there was no earned income based on being a full-time student or, what's it say here, number of months disabled or full-time student. So if we put something else, if we put like 7 months, then of course, and if we go back over and say, well, what would that do? We had the 30,000 for the one spouse and the other's at 1,750. What is that 1,750? What does that mean? Well, 1,750 divided by 7 months is, of course, that 250. So what they're saying is that you're gonna have the 250 basically per month for the purposes that are qualified, the number of months that qualified. In this case, we'll say it's a full-time student. Back to the text. Spouse works. If your spouse works during that month, use the higher of 250 or 500 or his or her actual earned income for that month. So then if we have a situation, full-time student and work was happening, then the question is, well, which is higher? The amount that you would get as a full-time student, which is this 250 or 500, or the amount that was received during work, which pick the higher one. Spouse qualifies for part of month. If your spouse is a full-time student or not able to care for himself or herself for only part of the month, the full 250 still applies, or 250 or 500 still applies for that month. So even if it's a partial month, then they still apply the whole amount there. You are a student or not able to care for yourself. These rules also apply if you are a student or not able to care for yourself and are filing a joint return. For each month or part of a month you are a student or not able to care for yourself, your earned income is considered to be at least 250 or 500. If you also worked during that month, use the higher of 250 or 500 or your actual earned income for that month. Both spouses qualify. If, in the same month, both you and your spouse are either full-time students or not able to care for yourselves, only one spouse can be considered to have this earned income of the 250, 500 for that month. So in other words, if we have two of the both spouses are full-time students and basically don't have any income, then we are not looking to get the 250 applied to both. They can only apply to basically one or the other for that month. Example, Jim works and keeps up a home for himself and his wife Sharon. Because of an accident, Sharon isn't able to care for herself for 11 months during the tax year. During the 11th month, Jim pays $3,300 of work-related expenses for Sharon's care. These expenses also qualify as medical expenses. Their adjusted gross income, $29,000, and the entire amount of Jim's earned $29,000 and the entire amount of Jim's earned income. Jim and Sharon's earned income limit is the smallest of the following amounts. Jim and Sharon's earned income limit. We have work-related expenses, is that $3,300, Jim's earned income, $29,000, and income considered by Sharon, which they're saying is going to be the 250 times those 11 months. So, and Jim and Sharon can use the 2,750 to figure the credit and treat the balance of 550, which is 3,300 minus the 2,750 as medical expenses. So note what they're going to say here. We're using this one, and therefore the difference can still be used. You can't use the medical expenses for both areas, but the difference they're saying can still be used of the 550 for medical expenses in some area, possibly like a Schedule A itemized type deduction. However, if they use the 3,300 first as medical expenses, they can't use any part of that amount to figure the credit. In other words, if they use the medical expenses somewhere else, they can't use the medical expenses to then calculate the credit. If they took the full deduction somewhere else with medical expenses, that's where they have to use it. They can't then use it for the credit calculation as well. In this presentation, we will discuss the dollar limit related to the child and dependent care expenses credit. This information can be found in Publication 503. Dollar limit. There's a dollar limit on the amount of your work-related expenses you can use to figure the credit. This is $3,000 for one qualified person or $6,000 for two or more qualified persons. Here we are on our test 1040 where we have the married filing joint return and we have the one dependent. As we scroll down line 1, we've got the $40,000 in the wages, the $24,000 being the standard deduction for the married filing joint, leaving taxable income $16,000, tax calculated by the system $1,603. And then we have the child tax credit. That's not what we're focusing in on here. We're focusing in on the child and dependent care expenses credit, which is included in line 12. and can also be seen on Schedule 3. 660 currently being calculated, also on Form 2441, Child and Dependent Care Expenses. We're saying that the expense amount paid, $6,000, one child, and so here's the amount of $6,000. Now this was the amount paid, not the limit, because there's one child. The limit is down here of the 3,000. Probably 6,000 wasn't the best number to use up there, but we have 3,000 is going to be the limit in this case. And then we have the other limits we've discussed in prior presentations of the amount earned, 30,000 by one spouse, 10,000 by the other. Then the limit for the one employee now being what is being used here, which is that $3,000 limit. If we switch this up a bit on the test 1040, we now have the married filing joint and the two dependents. We're going to say we have two dependents, same income information. We're going to go back down to the form 2441. And now we're going to say that we paid $11,000 to the same organization, but now we have the two dependents, 1 and 2, $7,000 for the one, $4,000 for the other, which would be the $11,000 on the total. And now, of course, we have the limit of $6,000 because we have the two dependents, and it's going to then take the lower of that information, which is now the $6,000. Back to the text. Tip. If you paid work-related expenses for the care of two or more qualified persons, the application dollar amount is $6,000. This limit doesn't need to be divided equally among them. For example, if your work-related expenses for the care of one qualifying person was $3,200 and your work-related expenses for another qualifying person was $2,800, you can use the total $6,000 when figuring the credit. In other words, it doesn't have to be, in this case, $3,000 or $3,000, or in other case, this one's not capped at 3, and then this one you only get the 2,008. They both are adding up to more than the 6,000, and therefore 6,000 would be the number to be using. Yearly limit. The dollar limit is a yearly limit. The amount of the dollar limit remains the same no matter how long during the year you have a qualifying person in your household. Use the 3,000 limit if you paid work-related expenses for the care of one qualifying person at any time during the year. Use 6,000 if you paid work-related expenses for the care of more than one qualifying person at any time during the year. So we're not going to do like a prorated type of thing. Well, this would be the cap only if it was all year. So it's, you know, anytime where the caps are 3,000, 6,000, 1 or 2 of the children that would be qualified. Example 1. You pay $500 a month for after-school care for your son. He turned 13 on May 1st and is no longer a qualifying person. You can use $2,000 of expenses for his care January through April to figure your credit because it isn't more than $3,000 yearly limit. Example 2. On July of this year, to permit your spouse to begin a new job, you enroll your 3-year-old daughter in a nursery school that provides preschool child care. You paid $300 per month for the child care. You can use the full $1,800 you paid, 300 times 6 months, as child care as qualified expenses because it isn't more than $3,000 yearly limit. In this presentation, we will discuss the reduced dollar limitation related to the child and dependent care expenses credit. This information can be found in publication 503. Reduced dollar limitation. If you received dependent care benefits that you exclude or deduct from your income, you must subtract that amount from the dollar limitation that applied to you. Your reduced dollar limit is figured on Form 2441, Part 3. See dependent care benefits earlier for information on excluding or deducting these benefits. So remember, what we're talking about with the dependent care benefits are typically going to be dependent care benefits we received from the employer. So if we got the dependent care benefits from the employer and we were able to reduce or deduct them from our income, then we already got a benefit from them, in other words. So they're reducing the amount of taxable income, and therefore we can't both get the reduction in the taxable income and use them to claim as part of our calculation for a credit. This is part 3 of Form 2441, so dependent care benefits. This is what we would need in order to make this calculation. Note that it's grayed out in this software, which typically means it's not always required. So it's not a required form all the time unless we have the need for part 3 which is dependent care benefits. Example 1. George is a widower with one child and earns $24,000 a year. He pays work-related expenses of $2,900 for the care of his 4-year-old child and qualifies to claim the credit for child and dependent care expenses. His employer pays an additional $1,000 under a qualified dependent care benefit plan. This $1,000 is excluded from George's income. So he got $1,000 from the employer, not included in George's income. So that's going to be the key point. Although the dollar limit for his work-related expenses is $3,000, one qualifying person, George figures his credit on only $2,000 of the $2,900 work-related expenses he paid. This is because his dollar limit is reduced as shown next. So he had the $3,000 typical dollar limit reduced by the $1,000 that wasn't included because he already got kind of a benefit for that from the employer, reducing the income, therefore not paying as high taxes on the income, to the $2,000, that being now the new dollar limitation. Let's take a look at an example with our test 1040. We have Adam Smith. We are now the head of household filer rather than married. We have the one dependent. So now we have the one dependent. As we scroll down, we have income $35,000 of income. Standard deduction $18,000 for the head of household status. $17,000 then being the taxable income, tax calculated at $1,771. And then we have the credit. We're not concentrated on the child tax credit. We're looking into the credit, which is going to be the child and dependent care expenses credit, which is going to be included in line 12. Also seen on Schedule 3. That's this $500. Also seen on the 2441. So on the 2441, we're going to say that the amount paid was $5,000 amount paid. And now we have this $2,000 here in the limit. So notice this is typically the dollar limit, and you would think it would be $3,000, but now it's being limited to $2,000. And the way we put that into this particular system, this particular tax system, and this will indicate where this might be on your W-2. And note this example is not exactly the same as the example we just looked at. I'm just showing how this number here could possibly be not the $3,000, but something lowered by the benefits that we would receive, those benefits then being reported to us by our employer on the standard form, that form, the W-2. So if we go back to the detail then, I'm going to say here's our $35,000, and if we looked at the W-2, then line 10, we might see something in line 10, which is related to dependent care benefits. That's the number, right? If I remove that, and I go back over here, and I say, all right, what happened? Back over here, it's going to go back up to 3,000. So now we have the limit at the 3,000. Going back over here, we're saying, all right, well, what if 1,000 was dependent care benefits? Then for purposes of this credit, it's going to make that limitation go back down to the 2,000 according to our software. Back to the text. Example 2. Randall is married and both he and his wife are employed. Each has earned income in excess of $6,000. They have 2 children, and I'm just going to ages 2 and 4, who attend a daycare facility licensed and regulated by the state. Randall's work-related expenses are $6,000 for the year. Randall's employer has a dependent care assistant program as part of its cafeteria plan, which allows employees to make pre-tax contributions to a dependent care flexible spending agreement or arrangement. Randall has elected to take the maximum $5,000 exclusion from his salary to cover dependent care expenses through this program. Although the dollar limit for his work-related expenses is $6,000, 2 or more qualified persons, Randall figures his credit on only $1,000 of the $6,000 work-related expenses. This is because his dollar limit is reduced as shown next. So obviously we have the maximum allowed expenses for 2 qualified persons typically would be $6,000. That would be our normal limit, minus the dependent care benefits selected from the employer's cafeteria plan and included and excluded from Randall's income. So again, they were excluded from the income. That's kind of the key point there. Already got a benefit if they're excluded from the income because they're not being reported as income on the W-2, or at least not for tax purposes, and therefore we can't use that amount for the credit calculation. And so line 3, 6,000 minus 5,000 is the 1,000 on line 3, which is reduced dollar limit on work-related expenses Randall can use for the credit. In this presentation, we will discuss the amount of the Child and Dependent Care Expenses Credit. This information can be found in Publication 503. Amount of credit. To determine the amount of your credit, multiply your work-related expenses after applying the earned income and dollar limits by a percentage. This percentage depends on your adjusted gross income shown on Form 1040, line 7, or 1040 NR, line 36. The following table shows the percentage to use based on adjusted gross income. So the adjusted gross income, fairly straightforward number. We've seen that before, also referred to as the AGI oftentimes on our test 1040. Scrolling down, we'll find line 7 right there. So that's really kind of our normal income. It might be adjusted by a few things. In this case, it's the $35,000. The above the line adjustments could affect this number. Those would be on the Schedule 1. And so these are going to be adjustments to income. These items may have an effect on it, but in essence, this is going to be adjusted gross income is kind of the standard number oftentimes used for at least a baseline of calculating things that are going to have an income cap or be based on income levels. Back to the text. So here's going to be our table. If your adjusted gross income is over this amount, but not over this amount, you're going to use this percentage. So we're just going to take that number on line 7, the AGI, the adjusted gross income, see where it lies. It's going to lie in between one of these two numbers, and we'll find which one it lies between. And if, for example, if it was 28,000, like it would be right between the 27 and then the 29, and then we would then use the percentage of 28%. Let's take a look at our example. In our example, we had the 35,000, line 7, adjusted gross income. If we go back to our Form 2441, see what the software does for us on Form 2441, we're picking up the 25% because the 33,000 to the 35,000 is where we landed. We're between 33,000, 35,000, therefore 0.25, 25% is what we use because our AGI was right at that 35,000. Also note we're right on the line here of the 35,000 for the 25% or 35,000 on the lower limit for the 24%, and the software's taking up or picking up the 25% on that case where we're right on the line at that limit, 35,000. Back to the text. To qualify for the credit, you must have one or more qualifying persons. You should show the expenses for each person on Form 2441, line 2, column C. However, it is possible a qualifying person could have no expenses and a second qualifying person could have expenses exceeding $3,000. You should list 0 for one person and the actual amount of the second person. The $6,000 limit that applies to the 2 or more qualifying person would still be used to figure your credit unless you already excluded or deducted in Part 3 of Form 2441 certain dependent care benefits paid to you or on your behalf by your employer. So let's take a look at this. If we have Form 2441, we have the child and dependent care expenses, and we're going to say now that there's $7,000 of the amount that was paid. We have two qualifying individuals, dependent 1 and dependent 2. However, we only paid $7,000 for the one. And what we're saying here is, well, if we had another one that's qualified, but we didn't pay any expenses related to that second dependent, then if we put them on here as a qualified dependent that we paid 0 for, and then we have $7,000 for the other dependent, then the software now you can see is calculating the limit at the $6,000 limit because we have two qualifying dependents rather than the $3,000, even though we didn't pay anything for the second dependent. The amount of the qualifying expenses is 0 in that case. Back to the text. Example. Roger and Megan Perez have two qualifying children. They received $1,000 of dependent care benefits from Megan's employer during 2018, but they incurred a total of $19,500 of child and dependent care expenses. They complete Part 3 of Form 2441 to exclude the $1,000 from their taxable income offsetting $1,000 of their expenses. Roger and Megan continue to line 27 to figure their credit using the remaining $18,500 of expenses. Line 30 tells them to complete line 2 without including any dependent care benefits. They complete line 2 of Form 2441, listing both Susan and James as shown in the line 2 example below. All of Susan's expenses were covered by the $1,000 of the employer-provided dependent care benefits. However, their son James has special needs and they paid $18,500 for his care. Line 3 imposes a $5,000 limit for 2 or more children, $6,000 limit minus the $1,000. So we have this large amount being paid, right? $18,500, but $1,000 of it was reimbursed by the employer, bringing it down. That also limited the top limit. So remember, it's $3,000 for one, or $6,000 for two. So $6,000 would be the limit for the two, minus the $1,000 that wasn't excluded because there was a benefit there. And Roger and Megan continue to complete the form. So now we're at basically the $5,000 limit. Even though line 2 indicates one of the pair's children didn't have any dependent care expenses, it doesn't change the fact that they had 2 qualifying children for the purposes of Form 2441. So it's basically saying that although one of the children didn't have any qualifying expenses because they were reimbursed, they still had the 2 qualifying children for the purposes of the form, and therefore they have the $6,000 instead of the $3,000 of the cap. Payments for prior year's expenses. If you had work-related expenses in 2017 that you paid in 2018, you may be able to increase the credit on your 2018 return. Attach a statement to your form showing how you figured the additional amount from 2017, then enter CPYE, credit for prior year expenses, and the amount of the credit on the dotted line next to line 9 on Form 2441. Also enter the name and taxpayer identification number of the person for whom you paid the prior year's expenses. Then add this credit to the amount on line 9 and replace the amount on line 9 with the total. See worksheet A. So if we go back to our form, this is going to be on line 9 here, and they're basically saying, well, what if we have a situation where we had the expenses in 2017 that we think that we should be able to then include in 2018 tax return. Example, in 2017, Sam and Kate had child care expenses of $2,600 for their 12-year-old child. Of the $2,600, they paid $2,000 in 2017 and $600 in 2018. Their adjusted gross income for 2017 was $30,000. Sam's earned income was $14,000, was less than Kate's earned income. A credit for their 2017 expenses paid in 2018 isn't allowed in 2017. It is allowed for the 2018 tax year, but they must use their adjusted gross income for 2017 to figure the amount. The filled in worksheet A they use to figure this credit is shown later. So Sam and Kate add the 162 from line 13 of this worksheet to their 2018 credit and enter the total on Form 2441, line 9. They enter the CPYE of the 162 and their child's name and social security number in the space to the left of line 9. In this presentation, we will discuss how to claim the Child and Dependent Care Expenses credit. This information from publication 503. How to claim the credit. To claim the credit, you can file Form 1040 or Form 1040-NR. You can't claim the credit on Form 1040-NREZ. So clearly we have to file the tax return being the Form 1040. If you filed a 1040A or a 1040EZ in the past, they no longer exist in 2018, and therefore you will have the 1040 and a schedule related to it, which will be necessary for claiming the credit. Back to the text. Form 1040 or Form 1040-NR. You must complete Form 2441 and attach it to Form 1040 or Form 1040-NR enter the credit on your Schedule 3, Form 1040, line 49, or Form 1040 NR, line 47. Here is an example of our test 1040. We have the two dependents up top. We've got the income of the $35,000. And to complete the credit, we will typically have the Form 2441. Oh, by the way, note that the 1040 is basically the 1040 is shortened from the prior year. So we don't have usually a 1040A or a 1040 EZ. What we have instead is a shortened 1040 and then the supplemental schedules as we need them, Schedule 1, 2, 3, 4, 5, and 6, which would have the longer kind of information that would be on the 1040. So it's actually kind of nice because then it doesn't confuse people that have an easy return or an easier return or less things involved to just still choose the 1040, which will be shorter, and then we'll tack on more schedules as necessary. So, and that's basically what happens here. So we have the 2441, which is the child and dependent care expenses. This is what we have to fill out in order to get this credit. We enter this information here. We'll talk more about that process. And then we get that bottom line number. That bottom line number is then going to be transferred to Schedule 3. So Schedule 3, which is one of those schedules that is an attachment to the 1040 now. And it includes, of course, non-refundable credits. In this case is the name of the Schedule 3 form. We're here on line 49, credit for child and dependent care expenses. And that's going to be from the attached 2441. And then that amount summed up down here on line 55 would then go to the Form 1040 line 12. So if we go to 1040 then, and we go down to line 12 is a little bit confusing because it does include that amount, but it also includes this amount for the child tax credit. So you'll note that we have the 271, and then the total here is the 1771. Well, where does that come from? Add any amount from Schedule 3, and check here. So it's this amount plus the amount from the Schedule 3. Back to the text. Limit on credit. The amount of credit you can claim is limited to your tax. For more information, see instructions for Form 10441. Tax credit not refundable. You can't get a refund for any part of the credit that is more than this limit. Note that if we don't have any tax liability, we may not be able to take this credit. For example, we could see here that $18,000 is the amount of the standard deduction, and we have $35,000 of the income, and that is a difference of the $17,000, and the tax then is $1,771, and we just saw the credit being calculated then on the 2441 here, and being pulled over to the Schedule 3. If I go back to the 1040, what would happen then if the income was only $18,000? Because that would result in no taxable income and no tax liability would be calculated. So let's take a look at that. What we're going to observe here is see if basically the Schedule 3 disappears and the 2441 disappears from the software because of the limitations with regard to not having any tax liability and this credit. So let's go back here and say, all right, well, what if we change the income to 18,000, and we go back to the forms? We're going to see now the 18,000 was the income. That's the W-2 income we're saying, and 18,000 is the standard deduction. No tax liability then. If we scroll down, we see no credit on line 12. And note that's because it's kind of these credits up top. Line 12 are usually credits that basically will not allow you to get any benefit beyond a zero liability. So if there's no liability, then the credit will typically take you down to zero and not below that for these items. These items down here, however, will take you beyond that. So notice there's no tax liability. Earned income credit and this additional child tax credit are still here under what we have in the system right now. But the credits up top in line 12 have been gone because really these credits are saying, hey, we're going to give a benefit as long as you have taxes that have been paid or will need to be paid. As long as you have some type of tax liability, these will help until the tax liability goes away. These down here are what they're calling refundable credits, and that's going to allow the tax liability to go beyond zero, getting a refund in this case of the $8,041, because these credits, not the one we're talking about here, this is the additional child tax credit and earned income credit, are the refundable credits that can actually result in money back even though nothing's paid in. The credit we're talking about here in line 12 is not among those credits, and that's up top. And therefore, when the tax liability goes to zero, typically we don't get any more benefit from the credit. Now, if we increase it slightly, you'll see we've got the 20,000. Now we're going to say that there's 20,000 of income minus the 18,000 standard deduction gives us the 2,000. So we have a little bit of taxable income. 2,201 then is the tax being calculated. You'll note then that the amount on line 12 is exactly 201 because that brings the tax liability on line 13 to 0. So there's basically a limit there of the amount of liability there is. If we were to increase this again then to, let's say, 21,000 of wages, you'll see now we're at 3,000 of income, 303 the tax, and now the credit has increased to 303 to bring the tax down to 0. That's before we get to, of course, the refundable items, the earned income credit and the additional child tax credit. Back to the text. Tax credit not refundable. You can't get a refund for any part of the credit that is more than this limit. Record keeping. You should keep records of your work-related expenses. Also, if your dependent or spouse isn't able to care for himself or herself, your record should show both the nature and length of the disability. Other records you should keep to support your claim for credit are described under care provider identification test earlier. Note that, of course, we do want to keep the information, not necessarily so that we can fill out the return, but the IRS could audit the return. Even if it's filled out completely perfect, the IRS could audit the return at some point in time. It could just be a random type of audit. And if they do, then we want to have the evidence to support what has been put on the tax return. I want to hold on to that for a period of time, at least 3 years, 3 to 5 years, so that in the case of an audit, and maybe even longer than that, but 3 to 5, in the case of an audit, we can provide that information when asked. And of course, in the future, we're not going to have as much awareness of what happened 3 years ago, so we want to log that information in as we go. In this presentation, we will discuss the topic of, do you have household employees with regard to the child and dependent care expenses credit? This information can be found in publication 503. Do you have household employees? If you pay someone to come to your home and care for your dependent or spouse, you may be a household employer. If you are a household employer, you will need an employer identification number. That's an EIN number. Employer identification number, and you may have to pay the employment taxes. So employment taxes, you might have to file the employment taxes, Social Security and Medicare possibly, as you treat the household worker as an employee, and go through the requirements with regard to that, including possibly reporting the employee information, W-2 type information, and withholding things such as the payroll taxes. Back to the text. If the individuals who work in your home are self-employed, you aren't liable for any of the taxes discussed in this section. So note that's going to be a big kind of difference in terms of, can we treat the household employees, do we have to treat them as employees, or can we treat them as self-employed? If they were employees, you would think that they would get a W-2 type income, and we would W-2 income, we would have to provide the W-2 and possibly be required to calculate things like payroll taxes. If they're self-employed, then they would report the income on Schedule C. We might just have to provide them a 1099 at the end of the year, which would be much easier to do. But whether or not they're self-employed or not, a contractor basically, or an employee, isn't totally up to basically our whims on what we think should happen. It basically comes down to how much independence the employee has in their job and those types of things. So if that's a concern, you want to basically look up the circumstances in which you can treat someone as a contractor versus those situations in which you would have to treat them as an employee. And if you have to treat them as an employee, you're required oftentimes to have more in-depth reporting, doing other things, possibly having withholdings and whatnot included. If they're self-employed, it's a little bit easier most of the time because you might just have to report the income you gave to them or paid them in the form of a 1099. Back to the text. Self-employed persons who are in business for themselves aren't household employees. Usually you aren't a household employer if the person who cares for your dependent or spouse does so at his or her home or place of business. So clearly, if it's in another home, we go somewhere else, then you would think, well, that's their own business. We're going somewhere else. That would be their own business. If they come to our home and are part of our home, then it's more likely that the IRS would say, well, that seems like an employee type relationship as opposed to a contractor type relationship. But that's one test to consider. Back to the text. If you use a placement agency that exercises control over what work is done and how it will be done by a babysitter or companion who works in your home, the worker isn't your employee. This control could include providing rules of conduct and appearance and requiring regular reports. In this case, you don't have to pay employment taxes. But if an agency merely gives you a list of sitters and you hire one from that list and pay the sitter directly, the sitter may be your employee. So notice one of the benefits of a placement agency then might be that if the placement agency basically is saying that these people that work there are the employees or possibly contractors or whatever of the placement agency, and the placement agency then has the control of directing where they go and what they do, what they wear, uniforms and that kind of thing, and having some kind of the regular system of their employment, then the burden is not so much, shouldn't be then on the household owner, then it'll be more on the placement agency, even though they're coming to the home. And that could be a useful situation because then of course you don't have to deal with the W-2 information and that kind of stuff. You would think that it would be done by the placement agency, and then you would just of course pay the placement agency with possibly, which you would think would then pay the workers, or in any case you would think the placement agency would have the need to report in some way as an employee or as a contractor. Now obviously if you're paying the placement agency rather than the actual individual, it would seem pretty clear that the placement agency the individual would be the employee. If you're paying the individual and not the placement agency, then that would be a little bit more unclear as to whether the placement agency is responsible for the reporting of that in terms of W-2 or 1099, or whether we are as the homeowner. So just some things to consider. The placement agency then could take some burden in that format of reporting W-2 type information. However, of course, then you deal with the placement agency, which puts one more level of intermediary between you and the person who's doing the actual caretaking. Back to the text. If you have a household employee, you may be subject to 1. Social Security and Medicare taxes, 2. Federal unemployment tax, and 3. Federal income tax withholding. So anytime we have these are typical kind of employee type taxes. So if we say that someone is an employee and the IRS is going to be specific, if the IRS, under the IRS law, they say that this individual is an employee, and you'd have to go over the types of rules that would be an employee. Do you have direct control over their conduct during that time period, or do they have more ability to direct their own system and this kind of thing? But if they are an employee, then these are the types of things you typically have to do. The Social Security and Medicare taxes, these are payroll taxes that you basically typically have to withhold and possibly pay as well, employer and employee portion. And so the way not to, and also it's just kind of a hassle to then be reporting the payroll taxes is not the easiest thing to do. So it's a lot easier to do a 1099 and treat them as a contractor if possible, or as someone that's working for another agency, which then of course would handle the reporting of this information if necessary, or the contractor information. Back to the text. Social Security and Medicare taxes are generally withheld from the employee's pay and matched by the employer. Federal unemployment (FUTA) tax is paid by the employer only and provides for payments of unemployment compensation to workers who have lost their jobs. Federal income tax is withheld from the employee's total pay if the employee asks you to do so and you agree. For more information on household employers' tax responsibilities, see Publication 926 and Schedule H, Form 1040, and its instructions. So if you have a household employee or are considering household employee, how to set up that relationship, then you might want to check out Publication 926. You can go to the irs.gov, irs.gov to find that information. State employment tax. You may also have to pay state unemployment tax. Contact your state unemployment tax office for information. You should also find out whether you need to pay or collect other state employment taxes or carry workers' compensation insurance. For a list of state unemployment tax agencies, visit the U.S. Department of Labor website. To find that website, use the link in publication 926 or search online. So then we got, of course, state laws could differ from state to state. We're considering here mainly IRS information, federal law. But of course, if you're dealing with an employee, then you got employee information for the state as well. And so you want to check out the state regulations for an employee as well. In this presentation, we will use tax software to take a look at some examples of Form 2441, how to calculate the child and dependent care expenses credit on Form 2441. Here is our test 1040. We have the head of household filing status. We've got the one dependent. We're going to scroll down and say that the wages was $50,000. $50,000 compared to the standard deduction, which is going to be $18,000. $18,000 for the head of household filing status leaves us with taxable income of the $32,000. Tax being calculated at $3,571. Then, of course, we have our credits. Child tax credit, not what we're concentrating on here. We're concentrated on the child and dependent care expenses credit, but we can see that $2,000 plus, well, the one we're concentrated on is the $2,600, and that gives us this tax after the line 12 credits of $971. If we go to Schedule 3, we'll see that $600. This is the credit we're looking for, the credit for child and dependent care expenses, which will be coming from or calculated on Form 2441. This is where we'll concentrate now, 2441. Part 1, we've got the organization that we have put in. We just put organization. We've got the address and then the ID number, which would be the Social Security number or EIN number, the amount that was paid to them, $7,000. Then we're going to say that we have the dependents, in this case only one, that we paid $7,000 for the care for to this organization. And so if there was more than one, of course, you would think that these two or amount of children would then add up to the amount that was paid to the one organization or multiple organizations up here. In this case, we have one dependent paid to one organization. Those two numbers then match up. So we then have the information line 7 or Part C, qualified expenses. And then line 3 says, add the amounts in column 3 of line 2. Don't enter more than $3,000 for one qualifying person or $6,000 for two or more qualifying persons. We only have one. So there's the $3,000. Line 4 says enter your earned income. There's only one person here, so the earned income is $50,000. In other words, we're not married, so just the $50,000 number. Sub 5 says if married filing jointly, enter your spouse's earned income. If you or your spouse was a student or was disabled, see instructions. All others, enter the amount on line 4. So notice the same number because we don't have to enter two spouses because there's only one because this was a married filing, or this was a head of household return. And then line 6 says, enter the smaller of 3, 4, or 5, which in our case is the $3,000, the dollar limitation for just the one person qualified. Then we're going to say that line 7, enter the amount from Form 1040 line 7. That is, of course, our AGI, adjusted gross income. Let's just check that out. If we go to the 1040 line 7, we can see our AGI is that $50,000. There were no adjustments to it, so that's just our W-2 wage in this case. Back to Form 2441. So that's going to be the $50,000. And then we're going to look at our table. Line 8 says, enter on line 8 the decimal amount shown below that applies to the amount on line 7. So we're using our AGI, or adjusted gross income, our income, and then we're taking these percentages. And of course, you can see that as the income goes up, the percentage that we're going to use, the decimal, is going to go down. So we're at 50,000. So if we go up to the 50,000, we're up to 43, up to no limit. We're all the way maxed out. So we're at the lowest kind of rate over here at the 0.2. So the 20% or 0.2. And then we're going to take the line 9 says multiply line 6 by the decimal amount on line 8. We'll take the 3,000 then on line 6, 3,000 times the amount on line 8, which is of course the 0.2 times 0.2. that's going to give us our 600. So notice what we took here, the 3,000, which is the lower of the income limit or the amount of the earnings, the earned income, and then we have the AGI over here. So we took the 3,000 times the 0.2 to get the 600. Line 10 here says tax liability limit. Enter the amount from the credit limit worksheet in the instructions. That's going to be 3,571. Now we could take a look at that worksheet, but if you go back to the 1040, notice if you look at line 11, that's going to be that 3,571. The 3,571 before we took basically the credits on line 12, which is the child tax credit, and including the child and dependent care credit in line 12. So the 2,000 from the child tax and the 2,600. So this is in essence our liability, because what we're doing is saying, hey, the amount of the credit can't be greater than basically this liability, meaning we can't have no liability and then take the credit and get a refund past the liability, is in essence what this limit is doing. So if we go back to here, we'll say that's going to be our liability. If we take a look at the worksheet, here's our worksheet. Enter the amount from Form 1040 line 11, and then enter the amount from Schedule 3 line 48. So that's going to be that information. And then, of course, the credit for child and dependent care expenses is the 600. Enter the smaller of line 9 or line 10 here and on Schedule 3. So here's the 600, Schedule 3 then, on 600 here, and then on the 1040, it's included in line 12, along with there's the 600 and the 2,000 for the child tax credit. Now, if we look at some scenarios, if we had basically two dependents, then we could see what would happen to this Form 2441. This amount could possibly be 6,000. So now we'll take a look at a situation where we have the head of household filing status, but now we have the two dependents here. So we've got two dependents, and then let's go to our form on the 2441 and see the same kind of calculations. Now we're going to say that we paid a total of 8,000 to the same institution for the two children. For the one child we paid 7,000. For the other child we paid 1,000. So then we see on line 3 it says add the amounts in column 3 of line 2. Don't enter more than 3,000 for one qualifying person or 6,000 for two or more. So now we have two or more. So here we have the 6,000. So the total paid 8. It's being limited to the 6,000, the amount that was paid. And then we have the income, which was 50,000. It's head of household, so that's on line 4 and 5. And then, of course, the smaller of those would be the 6,000 amount. And then we would go through and have the same kind of information as we go from there. However, now we've got, of course, the 6,000 times the 20%. 6,000 times the 20% gives us that 1,200, rather than obviously the 600 last time, which would be half of that. And then our liability here. So our liability is 3,571, which means that we're going to take the full 1,200. Now we're going to say that we have a married filing joint return rather than a head of household return. We still have the two dependents and we have the 50,000 still of the income, but now we need to know who earned the income between the two spouses to know how to break this out. That information can't be seen here, but will be reported on the 2441. So 2441, we're going to say we have the same 8,000 that was paid to this institution for the two children, the same 7 and 1 breakout between the two children. The max is still with the married filing joint 6,000 because that's the two children. And then in line 4, enter your earned income. So one spouse's earned income we're going to say is 40,000. And then now we have a difference in line 5. If married jointly, enter your spouse's earned income, which is now the 10,000. So the adding of those two then would be what's on the 1040, the 50,000. And then we're at the limit of the 6,000 because the 6,000 was our limit. And the 6,000, then 50,000 was the AGI. And we have the times the 20%. So we have that same 1,200. Now, we could see and imagine situations where this number is different, right? The 6,000 would be different if one of these two amounts was below the 6,000. So let's say that the second, our spouse had something below 6,000 of income. So now we're going to say there's the same 50,000, but the breakout now is the 45,000 and 5,000. And now we can see that line 6 then would be limited to that 5,000. So now it's limited to the 5,000 times the 20% is only the 1,000, and then we would have the 1,000. So that's one type of limitation that can be there. If we run another scenario, we're going to say now, let's say that on the form 1040, we have income of 35,000 rather than 50,000. So if we go to our 2441 then, we're going to say, all right, now we brought it back to 6,000, could be the highest amount that would be between the two, for the two children, qualifying children. Then we have the 25,000, we're going to say for one of the spouses, 10,000 for the other. Therefore, 6,000 is the highest of those three numbers. We'd have the 6,000, and then times the 0.25 would give us the 1,500, 1,500. And notice, of course, the 0.25 is coming from this table. So it's 0.25 as opposed to when we had a higher income, it could go down to basically 20%. So we're getting a higher amount there, which could be good, 1,500. However, it's being limited by this amount here. This is going to be the tax liability limit. And this tax liability limit, you can see, is on form 1040 line 11. So that's going to limit the deduction. Instead of 1,500, it's limited to 1,103. How is that happening? Well, if we go to 1040, note that 35,000 minus the 24,000 is 11,000 taxable income. The tax is then 1,103. And therefore, we're being limited to the amount of the tax. So we can't have the credit that's going to take the tax below zero, in other words. And so it brings it here. Now, these two credits could, because this is the additional credit, these are the refundable credits. So that's where that limit will fall, and that's how it basically works out here. We're going to have that limit. The other way a limit can work out, if we have the same information, but now we said we only paid 2,000 total to the institution, 2,000 instead of, I believe it was 7,000 or 8,000 last time. That means that we're going to say we paid 1,000 for each of the qualifying children, and then line 3 then is going to be limited to the 2,000. It's not going to be the max of 6,000. It's the lower how much we paid, or up to 6,000 for 2 children, 3,000 for 1. We've got the 25,000 and the 10,000 for the earned income, and then we're limited to of course, the 2,000, which of course is the amount we paid this time. And if we take that times the 25%, we get the 500. That being lower than liability for the 500 that we would then pull over to Schedule 3.